the FTSE could be a little cushioned by some of the basic resources.
Yes. In terms of some of the individual stocks that we're watching this morning, Anna, we start with a bit of M&A action. You've had Poste Italiane saying that it's going to launch a voluntary public offer valued at about 10.8 billion euros for Telecom Italia. So they're seeking full control of this former phone monopoly and setting up its delisting. Then we're watching the miners as well, because we've seen gold and silver tumbling on the inflation fears around the Middle East war. Copper also at its lowest in more than 3 months. And then Delivery Hero in focus as well. Gaining on TradeGate, it's agreed to sell its Food Panda operations in Taiwan to Grab Holdings, which is of course backed by Uber, that for about $600 million. So 3 to watch there for you, Anna.
Yeah, absolutely. So, Lizzie, we focus in on the negativity that we saw on Wall Street on Friday, the rhetoric over the weekend between Iran and the United States. All of it centered around the Straits of Hormuz, of course. We also focus on an Asian session that's been considerably in the red, down by more than 3% on Asian equities. But part of that was Friday's story. Part of that was the negativity that we saw on Wall Street, in Europe, during Friday's session. So what will we see here in Europe today? The Stoxx 600 does seem to be wanting to open in negative territory. I can't tell you a lot of detail about just how negative, but it does seem as if it wants to open in negative territory. The FTSE could be a little cushioned then, Lizzie, as we've been saying, because of the makeup, some of the oil majors in the mix there. Maybe we'll get more negativity coming through on the German market. There we go. But we've got the German market yet to open, as our graphics seem to want to have a life of their own this morning. Lizzie, what have you got for us?
Well, they're feeling very Monday. It's red across the screen for European equities. We've got the Stoxx 600 down 1.3%, the FTSE 100 down 1.5%, the CAC 40 about the same. We're waiting, as you say, for the DAX in Frankfurt. But if we look at the individual sectors, again, everything in the red. Bottom of the basket, utilities, technology and industrial goods and services down as well, all by more than 2%. The best performer is construction, autos and parts as well, but still they're down by more than 0.6% this morning. Now, we can check in on some of those individual movers that we'd been flagging. We said that the mining names were ones to watch, given, of course, the moves on copper, in gold and silver as well. And so we've got red across the screen yet again for those as well. So BHP, Anglo American, Glencore, Rio Tinto, all down this morning. BHP by 1.4%, but the rest down more than 2%.
Let's get a quick check on what's happening on gilt markets then, Lizzie, because we were primed for something fairly dramatic at the start of the trading week because of what had happened on Friday, because of the conversations all through the weekend and the narrative coming out of the Middle East. So the UK 2-year bond yield rising to its highest since February 2024. So that's the short end of the UK curve, where we see those gilt yields, yes, rising by 8 basis points. We see a rise at the 10-year horizon of 6 basis points. I mean, we saw substantial moves and bigger moves than this during Friday's session, but this is just another day of these yield moves to the upside.
And indeed, traders now fully pricing 4 quarter-point Bank of England hikes in 2026, not adding up with the message that we've been hearing from analysts that this just isn't possible to be hiking rates so much with such a weak growth backdrop in the UK.
Yes, and I think even the Bank of England governor suggesting that perhaps the market had got a little ahead of its skis, pricing in quite so many hikes when what we've got from them was a definite pause. Let us have a look at where we are on the broader market conversation this Monday, 23rd of March then. Let's bring in Maria Minucci, who is multi-asset fund manager at M&G Investments. Maria, good morning to you. Nice to have you with us. One of the questions I'm thinking about this morning is the extent to which you want to be invested, the extent you want to be in cash. I was listening to Warren Buffett talking just days ago, talking about how if this is prolonged, if you're talking about medium-term investments, maybe you want to stay in stocks, stay in the real economy, not in cash. But you maybe take a different view. What are you thinking about?
Well, our positioning going into this situation has been to have a relatively neutral exposure to equities, but with a very strong preference for markets outside the US. So within that neutrality in equities, actually having some very specific bets, for example, in Asian markets, which, even after the strong volatility we've seen in the past couple of weeks, they're still up considerably over the years. If you look at markets like Korea, for example, we have seen some very strong returns there at the end of 2025 and again into this year. What we've also enter this phase with is actually a relatively large amount of cash. And that has been very helpful in a situation in which actually we haven't had many assets diversifying out in this phase. And very interestingly, even assets that in 2025 had seen as a potential diversifier like gold has proven actually to be very unreliable in this phase. The dollar, I would say, has probably been the only area where we've seen a bit of diversification. Certainly not on government bonds, although it's still an area that we do like. And we think that maybe this reaction into this latest week has been a little bit overdone and might present some opportunities as well.
Okay, so interesting. So you keep some cash, and you say that means that when you see dislocation in these markets, you're able to reinvest. I mean, have we seen dislocation that encourages people into these markets, and if so, which assets?
Well, I think what we've seen so far has actually been a very measured response to a development of events that is pretty important for the global economy. Obviously, in different ways, depending on the different regions and how reliant they are on oil or on gas, but certainly a very, very important set of events from an economic standpoint. And the reaction so far, especially in equity, I would say has been relatively muted. Obviously, today we're seeing a little bit more volatility, but if you look at also the markets that have sold off the most are actually those that have gained the most in the previous weeks and months. So there's been a sort of profit-taking more than complete risk-off on this market. So at the moment, we don't see opportunities to re-engage yet in the equity complex at large. Obviously, there might be some selected opportunities. For example, Indonesian equities have been particularly weak. So at the margin, I think a little bit of a diversification there. But all in all, I think the response has been very muted. Where it has been less muted has probably been on government bonds, where we have seen a reaction function that was very significant. Obviously, there is risks of inflation reaccelerating, and the energy drive. It's very important, both from a direct consequence, but also the indirect consequence towards inflation. But the move we've seen is very, very significant, and I think it might start providing at the edges some opportunities, especially because it feels like at the moment the market is pricing in this inflation risk, but is not really pricing in the growth risk that could come with it should this tension and conflict remain quite extended.
Well, we've got loads of PMIs coming out this week. Do investors treat it, if they're weak, as bad news for earnings, or good news because it kind of takes off some of the pressure for central banks?
Well, it's a very good point, because at the moment, actually, we have seen this resurgence on interest rate expectation from a monetary policy front. So going from, stable monetary policy into 2026 in places like Europe, or, reducing rates to increasing rates significantly for 2026. And normally you will expect, this type of shift to have an impact on equities as well. But we haven't actually seen a lot of it so far. So I think it will be interesting to see, how the market takes this. And it's going to have a balancing act, especially given where governments are today from a fiscal standpoint. If you go into the economy and I correct significantly to respond to the inflation threats, then you're going to have to respond to support consumption in different ways. And not all governments are in the right shape to be able to do that like they have been doing in the past. So I think you will find a lot of tension between interest rates and fiscal expansion within government.
Especially in the UK. And we had gilt yields up last week. They're up again this morning. You're looking at the 10-year gilt yield up 5 basis points, the 2-year up 7 basis points at 4.6% this morning. And yet you see opportunities across the gilt curve. Where?
Yeah, I think, especially in the belly of the curve, we have seen such significant increase in yields that they make us think that potentially you have some opportunities. Again, the market is pricing in more of an inflationary risk than it is a growth risk for that market. And I would say gilts has been the epicenter of that volatility within bonds. But actually, if we look at other areas like BTPs in Italy, they've also seen quite a significant sell-off and move in yields. So there is potentially opportunities if we look in a longer-term perspective. Obviously, we're very careful of not making any focus around how things will play out. But there are different scenarios, and then we're trying to understand what type of weight is the market giving to the different scenarios. And I think at the moment, the one that seems less likely from a market pricing standpoint is this deterioration in growth. And maybe because we have seen in the past that, if we look back at 2022, you had an inflation spike, but then growth actually remained pretty resilient. So despite the volatility you had in equities in 2022, you then had some very, very interesting returns in the asset class. So many investors might be less willing to step back, knowing that eventually you will get good returns.
So you think it's going to be different this time then? It's going to be, the growth impact will be bigger compared to what we saw in 22, because bond markets do seem to be reacting just to this inflation concern, don't they? Is it just a question of time then, Maria? We just, in the end, we are going to pivot from inflation concerns to growth concerns on bond markets?
Well, it depends on many different factors, so we're not positioning ourselves for that scenario alone, but we do consider that as a possible scenario, which I think is something that the market is less inclined to, and so that's where we find opportunities at the margin. But we also have to say that we started this phase from a relatively strong growth backdrop, especially if we look at the US and the fiscal stimulus ongoing there. Oil prices was particularly low. We had a phase of oversupply in oil, so I think that also made it so that it took a little bit of time for the oil price to respond in a more aggressive way to the events that then took place.
If we can just come back to stocks, you can see there the FTSE 100 into correction territory, that headline just crossing the screen there. But you mentioned that you're underweight the US, and actually you've got some saying that we're getting to the point where big tech becomes irresistible. You're questioning how insulated it actually is from geopolitics, but because the Mag 7 is putting up these superior earnings and continues to, park Nvidia for a second, you've got some saying now's the time to buy.
Well, I think it's been a super interesting behavior of this part of the market in the last few months, because if you look at US equities, they've actually gone sideways for many months now, and they've been more resilient so far in this phase of volatility. But even within the tech sector, you have some very different behaviors. If you think about software at the beginning of the year and how much weakness we've seen there, and then actually in this latest phase of volatility, it's been a lot more resilient. So we have seen some opportunities within this sector to be able to add on a stock-specific basis. But overall, I think, the AI story, although it's got a lot of capital and strength behind it, is not going to be completely insulated by these trends, because there are elements of supply chains that might be impacted. There are elements obviously linked to the energy complex that, this sector is not completely insulated from.
Maria, can I ask you about corporate credit? We've seen spreads quite tight, of course. I wonder what you think about corporate credit right now, and if you don't like it, is it because of those spreads where they are now, or is it the risk around private credit and how we could see, some contagion really from the private credit markets into public credit? What are you thinking there?
I would say the starting point is the credit spreads and the levels that we're seeing today. We don't feel that you're getting compensated enough for the type of risks that we're seeing, in the environment. And specifically, this has been exacerbated by what has been happening on the private credit side, and, some of the early accidents that we've seen there. Obviously, it's not a complete given that you're going to have a spillover onto public credit markets, but it is the more liquid part, of that complex. And so if people have to de-risk, there is a possibility that will be the area that they will look at. I think an interesting way to play this is to be long the physical credit. We have a very strong team of fund managers that, can deliver alpha in this market still, but at the same time edge the overall credit spread, so edge the beta, and give us that possibility to then reopen the trade when we think there is opportunity, even in a market that is potentially less liquid.
Maria, thank you. Thank you for coming to see us. That's Maria Muniki, multi-asset fund manager at M&G Investments. Let's check in on the Core 6, shall we? It is, of course, red across the screen for the Stock 600, as it is for the Core 6 this morning. Particular losses for Rheinmetall out of Germany, also for Novo Nordisk. But as I say, every sector is in the red this morning on the Stocks 600. This risk-off mood as we have the tensions heating up in the Middle East. Let's get a check on some of the individual stocks that we're watching as well with Jennifer Creary.
Good morning, that's right. So we're seeing some of those, the impact of the fall in gold prices affecting some of those gold miners. We've got Antofagasta and Fresnillo down more than 3% on the open. That's, of course, as investors sell off from war in the Middle East. And there's growing concern over the risk of inflation, but also higher interest rates. And we can see that bleeding into some of the mining stocks this morning. Next up, we've also got an eye on Telecom Italia. Telecom Italia rising on the open, up 4.7%. Poste Italiane down 5.6%. That's after Poste Italiane said that it will launch a voluntary initial public offer for Telecom Italia valued at 10.8 billion euros. Those shares diverging on the open off the back of that bit of M&A news. Next up, we're going to flip over to Salzgitter. Salzgitter falling 6.6%. That's after the company, which produces steel products like steel tubes, reported sales that missed analyst forecasts. They reported a full-year loss of 70 million euros. Investors clearly unhappy with that performance. Finally, we're ending on ING. ING, the Dutch financial institution, falling 2.7% on the open. That's after it was cut to equal weight by Morgan Stanley analysts. That's part of a broader Morgan Stanley note from analysts turning more defensive on European banks. ING, one of the losers this morning. Back to you.
Jennifer, thank you. Jennifer Creary with an update on some of those individual movers. And there are some that are not responding to the broad risk-off theme that we see in markets. But overall, we see European equity markets then considerably weaker, down by 1.6% on the 1.5%, sorry, on the stock 600. The FTSE a little cushioned, the AEX a little cushioned by what we're seeing broadly, Lizzie, across these markets, but not really. I mean, energy stocks not performing the role they did last week, which is interesting in itself. So last week we saw energy stocks doing pretty well when other stocks didn't, and today we see energy stocks down by more than 1%.
Yeah, they're the second best performing sector of a basket of every sector being in the red. Consumer products and services lead the gains, energy in second place, but bottom of the basket, basic resources. We expected this, didn't we, given the moves that we've talked about in gold and silver to the downside. You are looking at gold weaker 5.4% now at $4,250 a troy ounce. And then when it takes you to the miners, Fresnillo down 3.7% as a result. Well, coming up, we have the IEA saying that more than 40 energy sites have been damaged by the Iran war. We'll discuss the implications for the sector next. This is Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazla Amin in Davos, Switzerland, and this is Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. This is the opening trade. Another Monday of negativity across these equity markets. So we're down by 1.7% across European stocks, and all sectors are in negative territory. The worst performing is real estate, but down by 2.5%. The impact of higher interest rates in these markets perhaps having an impact there. Let's talk about what's been happening in the Italian communications space, because there we see some considerable movement in these stocks. This after Poste Italiane said it will launch a voluntary public offer valued at 10.8 billion euros for the former Italian phone monopoly, that is Telecom Italia, of course. Joining us now for more is Bloomberg's Daniele Lepido, who is in Milan for us. Daniele, good morning to you. So what does Poste Italiane's bid mean for the future control of Telecom Italia?
Good morning from Milan. Telecom Italia is still in the spotlight again and again. And yesterday it was an early spring, late Sunday evening when Poste Italiane surprisingly launched this bid. What it means that the state is coming back into the economy. It means that Telecom Italia, after about 3 decades from the privatization, is coming back to the state. And Meloni government, as we know, is tightening the grip on a pretty strategical services and infrastructure like Telecom Italia. We also need to remember that last year, Telecom Italia completed the sale of its most valuable assets, so the network, to KKR. So what the Prime Minister Meloni wants to do is creating a fully integrated digital hub inside Poste Italiane. Please remember that Poste Italiane is a huge conglomerate with many services. It also owns MVNO, so a so-called virtual mobility network, a virtual mobility of phone operator. So the meaning is creating a big digital platform to compete with other bigger rivals in Europe.
So, Daniele, why is the government backing this kind of consolidation now?
Yeah, that's a good question. I think that this move by Poste Italiane could kick off a wave of consolidation among carriers, phone carriers in Italy. As you know, Italian telecommunication market is one among world's most competitive with very low prices. And in 2018, French Iliad entered the market and lowered again the prices. So let's see what's going to happen. But I think that all analysts agree on the fact that Italy needs to have 3 carriers rather than 4.
Thank you very much. Thanks for joining us, Daniele. Good to have you on the program. Bloomberg's Daniele Lepido joining us there from Milan. And we'll have more on this story as we bring you an exclusive conversation with the Telecom Italia CEO. That is coming up tomorrow, in fact, 9:30 a.m. London time.
Meanwhile, we have oil moving higher as investors assess President Trump's ultimatum to Iran to reopen the Strait of Hormuz, and Tehran's threat of more reprisals is being described as the largest ever supply shock for global crude markets. And Will Kennedy, our EMEA news director, joins us now for more. Will, let's say that this deadline tonight, it's 15 minutes before midnight London time, comes and goes. What happens to oil prices then?
Well, oil prices are still grappling with the fundamental fact that the Strait of Hormuz is still largely closed and presumably will remain largely closed after that deadline. I don't think anything fundamentally changes for the oil market, apart from the fact that this conflict will continue to seem intractable. If Trump follows through on his threat, however, it will be an enormous escalation, especially given the threats that Iran has made to retaliate against assets across the Gulf, including energy assets, and it will make a resolution to this conflict seem further off. So in either scenario, unless Iran capitulates and says, yes, we're going to open the Straits, which I don't think anyone expects based on what we've seen from Tehran so far, it's a question of will oil go a little bit higher or a lot higher.
Yeah, okay, and so and it is going a little bit higher at the moment, isn't it? Well, I mean, given the equity markets seem to be responding as if we got a lot of new information over the weekend, and a lot of it was negative. US futures pointing down by, well, it was just shy of 1%, now a little better than that, but still pointing quite negative. Oil prices just making very modest moves to the upside. But interesting, on the Brent curve, if you look further out the curve, actually we seem to be seeing more response and prices going higher further out the curve over the next year or couple of years. Does that give us a sense that maybe the market is increasingly thinking about the longer-term impact of this?
I think if we look at the market reaction across the board today, clearly it's about pricing in the fact that this conflict isn't going to stop anytime soon, and even if it does, there won't be a clear and quick resolution to the problems that we've seen build up through the global energy system over the last few weeks. I think many traders that started this conflict thought it would be short-lived, and you saw a lot of people trade oil on that basis. But as we go longer, the dislocations through the global energy system get worse, and the time it will take to get things back to normal increases, which is why we've seen the sort of pricing action further out that you described, Anna.
And indeed, in terms of that retaliation, you've had Iran just threatening to mine the Persian Gulf if its islands and coast are attacked. So it's only a heightening of the rhetoric on both sides coming now. Usually, when it's Sarah Week, Will, we would be talking about that when it comes to the oil market. But of course, the focus is on the Middle East. Is there anything that we should be watching out for in particular there?
It's an interesting moment for the shale industry. Obviously, these prices are allowing the shale industry to sell forward a lot of its production at higher prices. So it probably means that those concerns about production in the US that we talked about from time to time about shale slowing down, peaking, it probably suggests that it's giving the financial framework for the shale industry to continue drilling, to continue trying to exploit those resources as much as possible. So it's probably fairly bullish for the outlook. But of course, the other big question for the US is this ratcheting higher of product prices. We talked a lot about diesel at $5. We've got gasoline at $4. And the economy in the US is very sensitive to these prices, especially when it comes to consumer sentiment.
Yeah, and interesting that we do see WTI moving as much, if not more, than Brent today, because last week we talked about a divergence.
The divergence was incredibly stark. We saw the spread between WTI futures in New York and Brent futures in London blow out to levels much higher than we normally expect, and there are reasons for that. Clearly the US is more self-sufficient. It's to do with the types of crude that are produced in both countries, but there was always going to be a bit of a catch-up, and the US administration has been really keen to keep a lid on WTI prices, but there's only so much that can be done.
Yeah, absolutely, and today we see them go over $100 a barrel, so 100 spot 29 is where we trade right now. Thanks very much, Will, for bringing us the analysis. Bloomberg's news director for Europe, Middle East and Asia, Will Kennedy. Coming up on the programme, we speak to Barclays chief US economist, Mark Giannoni. We'll get his take on the Fed, the US economy in the context of war in the Middle East. That's next. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back, everybody. 30 minutes into Monday's session, and the European equity markets in the red, firmly in the red, down by 1.9% on the Stocks Europe 600. The Xetra DAX getting the worst of the losses this morning of the major markets, down by more than 2%. The CAC 40, the FTSE 100, though, not far behind. And that's interesting that the FTSE 100 is selling off almost as much as some of the other markets here, because it had been cushioned by the resilience of the energy sector in recent trading days. Energy is kind of resilient today, but it's still in negative territory as a sector, as an equity market sector, and so that is something that is a little bit different from what we saw last week. Lizzie, what are you seeing under the hood in these markets?
Well, that negativity is pretty universal this morning. As you can see here, we have got volumes higher, but 579 members are in the negative territory today. Only 19 managing to eke out gains this morning, so reflecting what you've just shown us across the continent when it comes to the geographical breakdown. Let's have a look at the leaders and laggards this morning. Some of the leaders include Telecom Italia. We had that Posta Italiana offer earlier, so Telecom Italia up 5.4% at the moment. It's the reverse for Posta Italiana. BP, meanwhile, because we've got oil, we have got oil prices higher, but BP shares actually down 0.3% following the risk-off mood elsewhere. And Pandora shares up 4.3% this morning. We've seen precious metals moves, significant moves, and so Pandora up 4.3%. Let's take a look at the laggards as well. Siemens Energy is down 3.2% at the moment. ASML down 1.2%. You've seen that AI tech sell-off, and then Rolls-Royce shares down nearly 5% because, of course, we have continued reduced air travel, Anna.
Let's talk about some of the individual stories that we're focused on this morning. And LaGuardia Airport is closed this morning after an Air Canada Express flight with 76 people aboard collided with a vehicle shortly after landing. Police say the aircraft hit a Port Authority of New York and New Jersey ground vehicle. NBC News is reporting that both the pilot and co-pilot died in the collision. German Conservatives, led by Chancellor Friedrich Merz, have dislodged the Social Democrats from power after 35 years in the southwestern German state. The win comes as Merz struggles to gain nationwide traction among voters. And meanwhile, in France, Marine Le Pen's national rally fell short in its bid to take control of a host of major French cities in Sunday's municipal elections. In Paris, socialist Emmanuel Gregoire was on course to win the race for mayor, extending the left's quarter-century hold on the French capital. And the US and Iran are trading threats as the conflict enters its 4th week, showing no signs of de-escalating. US President Donald Trump issued Iran a 2-day deadline on Saturday to reopen the Strait of Hormuz or face its power plants being bombed. While Iran's National Defense Council is reportedly saying that the entire Persian Gulf will be in a similar situation to the Strait of Hormuz if there's an attempt by US or Israel to attack Iranian islands or its coastline. Lizzie.
Well, the turmoil in the Middle East has sparked a rise in Treasury yields, with more traders pricing in a chance of a Fed rate hike by October, amid the concern that a protracted conflict could stoke inflation. Joining us now for more is Mark Giannoni, Chief US Economist at Barclays. Mark, good to have you with us in the studio.
Thanks for having me.
You don't think that's right. So I've talked about what traders see. They're pricing out Fed cuts this year. They're raising bets of a Fed hike by October to 50% as of Friday. But you see the Fed cutting in September and then again in March 2027. Why are they getting it so wrong?
Well, I mean, it's always difficult to say that the market is wrong because obviously the market takes incorporates a lot of information. But we do think that the Fed is going to cut this year in September most likely, and then again in March 2027. And the reason for that is that it's true, oil prices are pushing up headline inflation, but core inflation in the US is unlikely to move up a lot, at least if oil prices remain roughly where they are, and they are, according to the futures, also gradually declining after that. Headline inflation typically responds very quickly, but then we experience disinflation once oil prices have stabilized, and then core inflation, as I said, is unlikely to move very much in the near term. It's more gradual. And then there are also disinflationary pressures affecting core inflation at this point. Tariffs effect have largely passed through, and we think their effect are going to gradually come down from here. The housing inflation is gradually coming down as well, and services inflation is not growing fast, and in part this is because wage growth has largely stabilized.
But at what point, where does the oil have to get to for you to be more concerned about inflation?
Yeah, so we would need to see oil prices remain very elevated and potentially continue to rise in a very persistent fashion. And that's where we would see core inflation gradually move up and stay elevated for some time. And if this realizes, we are unlikely going to get the rate cuts. Actually, Chair Powell said as much last week. The FOMC also seems to expect a decline in rates this year as well as next year. But Chair Powell also said that this is conditioned on inflation gradually coming down.
So you still then expect that there will be a cut to Federal Reserve interest rates then, right. Mark, good morning. What about the rest? Where does that leave the rest of the world? Because are we going to be pricing something very different in Europe to the US, or will they converge to some degree?
Well, we think in that case they would converge most likely. So our European teams expects the ECB to raise rate later this year, and so that would lead to some slight convergence in rates. I mean, we're not talking about very large move both from the ECB or the Fed. I mean, if the Fed cuts, it's probably no more than one cut this year, unless the labor market suddenly deteriorates. And we've seen lots of fluctuations in the spread between the policy rates in the U.S.
And what do we need to know about the dual mandate of the Fed? And because that obviously sets it apart from some other central banks. When these mandates are in conflict, they need to prioritize the labor market. Is that the case? And to what degree do you think? When will that start to become a valid or an important factor?
You're absolutely right. So in the U.S., the dual mandate is absolutely critical. I think what the Fed does is looking at to what extent inflation deviates from their target and the labor market or the unemployment rate, let's say, deviates from what they assess to be the normal rate for the unemployment rate. And over, what's the persistence of this deviation from that target? So if we did see a sudden increase in the unemployment rate, the Fed would very much focus on that, we think, on that part of the mandate, because they know that if the unemployment rate suddenly rises, it's going to take some time until the unemployment rate comes back closer to what they think is the longer run neutral. Whereas in this case, the inflation spike is more likely to be quite short-lived if it really turns out to be that oil prices stabilize.
And how long does the war have to go on for you to even start thinking about a recession in the US?
Yeah, so a recession, so we don't think a recession is a very likely outcome at this point. It's definitely not in our baseline. A recession always is possible in any given year with maybe 15-20% probability. We think we would need to see further rise in oil prices, very persistently so that the consumer spending, which is already, we think, on a downward trend, suddenly falls more abruptly. Again, we think the fundamentals in the U.S. economy are still show a lot of resilience. So we think it's unlikely that we see a very abrupt decline in consumer spending. But if we did see that, we would likely see a pickup in the unemployment rate, and all sorts of other recessionary dynamics might kick in.
Okay, so that's the outside scenario.
Right.
Again, you are expecting the Fed to cut in September. How much does that come down to the change at the top, the idea that we might be getting Kevin Warsh? Will the Fed's reaction function change if he is the Fed chair?
Great question. I mean, we don't think that the change in the leadership of the Fed would dramatically change the policy reaction function, at least in the near term. The monetary policy is decided by the entire committee, so 12 policy members, and the other FOMC voters are pretty independent in their thinking, and they like to maintain that independence. So I think it's going to be very difficult for a new Fed chair to radically change the policy reaction function. And besides, I mean, assuming that Kevin Warsh gets confirmed in the next several months, we don't think he's particularly dovish either. Historically, he has been more on the hawkish side, so it's not clear that he would push for many more rate cuts than what the FOMC wants.
It was clear from the last Fed meeting then, Mark, that the Fed is watching for inflation to come down as a result of the tariff effects dropping out. What role is AI going to play in complicating that inflation dynamic in the US? Because we've seen, before we were talking about, always and everywhere about the Iran war, we were talking about AI all the time. And we were talking about a huge amount of CapEx and investment going into AI. And some have suggested that in the short term that might be inflationary. On the other hand, job losses. So what's your latest take on what this does to the short-term and medium-term outlook for the U.S. economy?
Yes, very well. So I think in the short term, as you alluded to, I think it's more inflationary in the sense that it creates more of a drain on resources. There's more employment involved in building the whole infrastructure related to AI. Actually, we think it contributed a lot to spending last year in terms of equipment, computer-related equipment, data center, software investment as well. So that involves a lot of activity, employment, and also slightly inflationary as it requires more resources to be built. Longer term, it may well be disinflationary in the sense that it improves productivity, and over time we may be able to produce more with fewer employees, and it may dislocate the labor market. But this is a much longer horizon, we think, than the near term that we are talking about. So when we talk about like 2026, 2027, we think we are not yet going to see all of these disruptions to the labor market or the disinflationary part.
But how much do you think that AI boosting productivity growth will raise the neutral rate?
For policy rates. So we think there is a chance that over time, to the extent that growth rate of the economy is going to be boosted by AI, but this is, again, over longer term, that it would eventually lead to a higher neutral policy rate. But there are other factors going against that. So demographic factors are really important in the U.S. as the labor force is now pretty much flattening out as you see more and more people moving to retirement. We are seeing also other factors that are contributing to potentially the lower policy rate over time. But AI could be an offset to that. So we think, again, this is something that would happen a few years down the road, not in the near term.
Mark, what's the risk to the scenario that we've just discussed? What's the risk to the fact there's no recession, that you get one rate cut, though, coming through in the US? What's the biggest concern? Is it to do with the Middle East, or is it something more domestically generated?
I think in the near term is very much the Middle East. Nobody knows, I guess, what the outcome of this war is going to be, how long it's going to last, how elevated the oil price shocks could be, and for how long. So I think these are all huge question mark, and Chair Powell alluded to that during the last press conference. So we think if oil prices remain much more elevated than in our baseline, so more elevated now and don't experience this decline than that the futures seem to indicate, then I think we could see at the same time more inflation and more of a downturn.
Yes, Chair Powell was also very clear, saying they don't have a huge amount of conviction about their forecast for the rest of the year because of all of those uncertainties. Mark, thank you very much. Thanks for coming to see us. Mark Giannoni, the chief US economist at Barclays. Now, the chief executive of UBS says energy prices are likely to stay elevated as investors digest the impact of the war in Iran. Sergio Amotti spoke exclusively with Bloomberg at the China Development Forum in Beijing.
This is basically the biggest topic we have been discussing lately. Of course, the good developments of China are somehow on the side for the second. But, you know, when I go back to that, I do believe that China will continue to have a pretty good growth driven by innovation and the desire really to address also the topics of climate through innovations. And so, but in a sense, you know, that kind of growth may be derailed by what's going on right now in Iran. Energy prices are likely to stay high for the foreseeable future, putting some inflation pressure and also some pressure on the delivery chain or on the supply chain, and in that sense, the situation is a little bit unstable.
We're into the fourth week of this war with no end in sight, really. There's ultimatums out there. There are surely mitigation plans being put in place by businesses. What do you see as the direct cost to your business and your clients right now? And with no end in sight, how does that translate to mitigation advice?
But we saw clients already diversifying their portfolios early on this year. You saw much more dispersion in the way they were looking at maybe shifting away from more the AI technology to a more diversified portfolio. That was a good move, considering what we see in the last few weeks. At this stage, clients are still, broadly speaking, calm. We don't see any major shift in asset allocation, but of course, you know, this pressure that I mentioned before on the economy will start to weigh into the market.
The UBS CEO Sergio Amotti speaking exclusively there to Bloomberg's Stephen Engel. Well, coming up, we'll bring you more on the broad market sell-off as we dive deeper into today's moves and look ahead to this week's macro events. We are very negative here in Europe. The Stoxx 600 down 1.9%, but it is red across the screen for European equities as we see oil higher at 114 on Brent, up 1.7%, a risk-off mood around the world. Stay with us. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to the opening trade. We are 49 minutes into a European session this Monday morning that looks really quite negative for European stocks, down by 1.6%. The FTSE 100 a little protected, perhaps. The CAC 40 a little protected from what's going on, but not as much as it was last week in the case of the FTSE. The Xetra DAX getting the worst of the selling, down by 1.8%. And if we look stateside, Lizzie, we see US futures are also weaker, suggesting that this has another day, perhaps, to go.
Yes, indeed. But let's get some analysis. Skylar Montgomery-Koenig from our Bloomberg Markets Live team joins us, as well as Rod Turnbull from Bloomberg Intelligence. Welcome to you both. Rod, I'm going to start with you talking about the equity picture. There's an interesting piece from our colleague Michael Masika on the terminal today, saying that, and this is according to a survey, market strategists are quite sanguine actually about the inflation fears because of the war, and they expect European stocks to return to record highs. There's a nice quote in here from Bank of America saying that the level of bullishness on European equities is diminished but not derailed. Does that tally with your view?
Well, it's interesting. It's always over a weekend. And, in terms of foreign policy from the U.S., this is probably the most sclerotic weekend we've had. So, of course, it had that sense of foreboding.
And I should point out that this survey was pre the ultimatum, but post the start of the war.
Yeah, so, it had a sense of foreboding over the weekend. And, of course, now we're coming back on a Monday with risk perceptions very high. Who has a crystal ball and can tell where this goes and where the timeline may end? But when we look at a number of barometers, which is what our equity strategy team's doing, Laurent Douillet in particular, we'll look at equity markets, and we're getting back to support levels in the likes of the S&P 500 and the SXXP. The Nikkei seems to be heading that way. We've obviously seen bonds spiking, bond yield spiking, the oil price spike. Five-year CDS has certainly moved as well, and it's getting a little bit more concerning. But I suppose when we look at this, in terms of fair value, and now all feeding into our fair value model, we're looking at a world where we were 16 times PE, say a couple of months ago prior to this conflict, and we're now looking at 14 times, which we think is about fair value.
So does that mean? But so things are cheaper in Europe. European stocks are a little cheaper, maybe around fair value. But are investors willing to step in right now with things looking, as to use your word, as sclerotic as they did over the weekend?
Oh, for sure. You think there's risk management been done, and people will be looking at markets now in those key barometers, right? I mean, if we look at EPS growth, we were 11%. The market was discounting 11% EPS growth in Europe back end of last year. We were about 3 to 6%. So we do think there's some downside, but it's not quite Armageddon levels yet. And so, of course, next up will be the results season. It won't be so much about the results themselves, but the look forward of the companies. And, higher oil prices, higher inflation, lower growth, that's all going to play into this. So the question will be, is 14 times about right, or do we have a little bit of a downgrade from the market coming? And one would assume the latter is probably true.
Yeah. Skylar, let me bring you in here, because we've seen some real outsized moves when it comes to precious metals. Gold's now down 5.7%, 4235 is where we trade. Silver down more than 5% as well at $64 an ounce. Bringing it back to equities, though, how much are the losses that we've seen on the Kospi in Asia tied to what we've seen in precious metals on silver?
I think it's all around this environment that we had prior to the conflict, where you had so much money rushing into very small markets. So the Kospi is one of them, gold is one of them, silver is one of them. And because that, it means you have an environment that has higher volatility. And so that means that there's more room for de-risking. More money can certainly come out of those markets. We're only undoing the year-to-date gains in gold. We had many years of big gains before that. And it also means that you can't rely on your kind of historical relationship. So gold has been used as a safe haven previously, but because you've had a huge amount of money shift into that market, it means that you had structurally higher volatility in that market as you entered this year, and that's not something that you want in a safe haven. It needs to be a store of value, and so it just negates that property entirely. And then as we've seen year to date too, or at least on the conflict in Iran, it's not had a negative correlation with risk assets, so that's another kind of tick against it in the safe haven column.
Skylar, can I ask you about bond markets and where we maybe are nervous that stretched governments, where they exist, are going to be wanting to help out their populations with the higher energy costs, and where that's going to be difficult for bond markets to absorb. So we see bond yields going a little bit higher here in Europe once again. They certainly were a lot higher during Friday's session. I'm drawn to a couple of examples of this, and they're not all from Europe, but just this morning, Greece saying it's taking more measures to address the surge in energy prices. China, very different geography, different story, but of a similar theme, saying it may adopt fiscal and tax support if crude prices surge. This is going to be something that catches on. Where are you concerned that we don't have the ability to do this?
Yes, I mean, this is a big concern because we're coming from a period where you already had deficits increase quite substantially because there was support provided to higher energy prices in 2022, 2023. So there are a couple places that are kind of fiscally vulnerable, like France, like the UK, and we've had yields rise at the end of last week, partly on this acceptance, I think, greater acceptance that energy prices will stay elevated, but also because of the monetary response, where monetary policymakers have said that they're more prone to react to supply shocks post-2022 than they maybe have previously. And so we've gotten the monetary policy reaction, but we're still waiting on the fiscal. Now, Starmer is meeting today to talk about whether or not there'll be more spending in the UK. And this is a very vulnerable market. Not only because post-2022 we had the Liz Truss crisis, so you get a more reaction from the market whenever there's something done poorly in the UK, but also because so much of the UK debt is inflation linked. So you get this really negative cycle when inflation rises, where it means that the Bank of England needs to hike because there is more of a response function within the UK to higher inflation, but you also have debt servicing costs rise automatically as a result of that, which means your fiscal position gets worse from the debt servicing side, but also growth being lower means you have fewer tax receipts. So the UK has seen underperformance, and I would expect that underperformance to continue.
So, Rod, let's say that fiscal support is not forthcoming, but the hikes from the Bank of England are. Where does that leave domestically focused UK stocks?
Well, I suppose in that position of people will be looking at defensive type plays, I guess, for the time being, and rightly so. I mean, the escalatory pathways to this conflict look pretty bleak and fraught with risk. So when we think about sectors that we're quite interested in, defense is obviously going to be one that people will probably keep exposure to. One could debate what's currently discounted in the valuation of some of these stocks, but regardless, you can see people will likely pull the defensive lever and stick with something like that. The other area that I'd mention, though, as well is pharmaceuticals. One of the things that we do in BI is an enormous amount of patent risk work, and we've looked at 4 of the world's biggest drugs from 4 of the world's biggest pharma companies, and the assumption that we're making is they're protected much longer than the market currently assumes, therefore higher revenue. So plays like that should be of interest.
Really interesting. Thank you for that. That's Rod Turnbull from Bloomberg Intelligence and Skylar Montgomery-Koenig from Bloomberg Markets Live. Thank you both. Well, plenty more coming up on Bloomberg TV today.
Absolutely. We are going to be hearing from Fed Governor Stephen Miron, 12:30 London time, the sole dissenter at the last Fed decision. So not a surprise, perhaps, that he dissented, but interesting to bear that in mind as we hear from him. European equity markets then very much on the back foot this morning. We'll leave you with the team on the pulse. This is Bloomberg.
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini.
We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this field forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The global sell-off deepens. Stocks, bonds, and gold all falling as the U.S. and Iran step up their rhetoric. President Trump threatens to attack Iran's power plants unless the Strait of Hormuz is reopened by tonight. Iran doubles down with fresh strikes across the Persian Gulf. Plus, Italy's Poste makes a 10 billion euro bid to delist Telecom Italia, turning from its biggest shareholder into its owner. Now, this is a picture across the board for what we're seeing in asset classes. Again, fears of this possible escalation in the war in the Middle East is driving sharp declines in stocks and bonds after the U.S. and Iran toughened their rhetoric. U.S. crude hitting $100 a barrel, gold falling to its lowest level this year, global yields surging as concerns that higher oil prices would stoke inflation definitely intensify. That means the UK 10-year yield has moved quite significantly at 4.673 and Brent 113.37. Now, the picture for the European map is actually quite significant in following some of the declines that we've seen overnight also in Asia. And you can see there's just a lot of red on your screen. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. and Iran continue to trade threats with the conflict now in its fourth week. Under pressure to bring down surging oil prices, President Trump issued Iran with a two-day ultimatum to reopen the Strait of Hormuz, which ends at 7:45 p.m. New York time today. So let's get more from Bloomberg's Abir Abu Omar. Hi, Abir.
Good morning, Francine. So the clock is now actually ticking down on President Trump's 48-hour deadline for Iran to reopen the Strait of Hormuz or have its power plants bombed. Iran has countered that if its power facilities are attacked or if it would close the Strait of Hormuz completely. Now, in a Truth Social post, President Trump said that Iran must, quote, fully open without threat the waterway. Meanwhile, Treasury Secretary Scott Bessent said U.S.-Israeli attacks on Iran are aimed at destroying its fortifications along the Strait of Hormuz. Now, the strait, of course, which carries a fifth of the world's oil and LNG supplies normally, has been effectively shut, as we've been saying, since the U.S. and Israel began attacking Iran late February. Now, this has pushed Brent prices up by more than 50% since then. Iran's strikes in the region have been continuing across the Arab Gulf, but also in Israel. The U.S. has also ramped up pressure and deployed additional troops and suggested that it may strike the oil-exporting Kharg Island. The Iranian military also said that it will target energy, IT, and desalination infrastructure that is linked to U.S. and Israel across the wider region, with a senior Iranian official adding that the headquarters and assets of financial entities that buy U.S. Treasury bonds are, quote, legitimate targets. The escalation in this rhetoric, Francine, by both the U.S. and Iran has driven a global market sell-off. We've seen this morning with Europe's stocks 600 set to enter into correction territory, and gold that is now slipping to around $4,200 an ounce. Francine, back to you.
Okay, Abir, thanks so much. Bloomberg's Abir Abar there with the very latest on what happened at the weekend. Markets definitely risk-off today as a sell-off in stocks, gold and bonds deepen. Let's discuss all of this with Seema Shah, Chief Global Strategist at Principal Asset Management, and Paul Wallace, our Middle East and Africa Managing Editor. So thank you both for joining us. Seema, first of all, I mean, the market is oscillating between risk-off, panic, and actually things will be okay. Is this, I mean, where are we today?
Well, look, I think once the European close happened on Friday, I think there was hopes that we could have hit the peak worst point, and that over the weekend there may be better news, the markets would have seen some light, and then today would be a better story. Unfortunately, I'm sure anyone looking at the market this morning will have been quite dismayed to see that even after such a significant sell-off on Friday, we've seen that continuing into Monday. Now, it's not as severe as what it was on Friday, at least so far. But the fact that it's continuing just tells you that the market is very concerned about when is this going to end, how far oil prices are going to move, and what's next. I think that's really the key question.
I mean, how do markets find a floor?
So I think we have to get to peak, the peak point where markets fully confronted what the risks are, fully confronting the idea that this is going to be a very prolonged conflict, very likely. And even in terms of once the strait is open, the fact that actually oil and energy, other commodities which are reliant on that, is going to take several months to get back to normal. So I think we did see some last week with central bank expectations moving to hikes, but there's probably a bit more to go.
I mean, Paul, I mean, this, I guess, is a concern, is that there was an understanding in the markets that there could be some kind of off-ramp. And when you hear Donald Trump, one time out of two, he says, look, we're nearly the end of the conflict, but it's unclear how this gets de-escalated.
Exactly, and the other time out of two, he's talking about hitting Iran harder or whatever the case is, and that's the situation where we're in right now. On Saturday night, Trump gave Iran a 48-hour deadline to reopen the Strait of Hormuz on his terms completely, as he put it, or face the obliteration of its power plants. If Trump follows through with that threat, that is a major escalation. Iranian officials have come out and pretty much all said that if the U.S. does that, then water and power infrastructure in Israel and in Arab Gulf states are going to be targeted, and we know that Iran can cause significant damage. We've seen this already with strikes on the likes of Ras Laffan, the LNG terminal or production site in Qatar, and energy sites across the region. So it's a real threat, and that would mark escalation if Trump decides to go through with that, because in all honesty, Iran is not going to reopen Hormuz by tonight as Trump wants it.
I mean, what does Iran want?
This is a good thing. We've reported that one of the things it wants is some kind of guarantee or pledge from the U.S. and Israel that they won't attack the country again in the event of a ceasefire or this current war ending. It also wants reparations. I mean, these things are pretty much non-starters as far as the U.S. and Israel are concerned. It's going to be, they're not going to give reparations to Iran. They may be able to unfreeze some assets and allow Iran to classify that as reparations, but it's very difficult to see Trump and or Benjamin Netanyahu saying to Iran, we are not going to attack you in the future or give any kind of pledge that strikes in the future on Iran are off the table.
Seema, I mean, we also heard from the IEA that more than 40 energy assets across the Middle East have been damaged since the conflict. I mean, is there, again, can oil go to 200? It's unclear at the moment. There's a lot of stockpiles that are being released, but then we don't fully understand the scale of the damage that's been done to a lot of this infrastructure.
Right, and I remember, just a few days after the conflict started, we did see a couple of estimates suggesting that $150 to $200 a barrel would be possible if you get a multi-quarter stoppage of the Strait. Certainly that is, we are moving close to that point, but again, at the same time, Brent has, it hasn't had a very significant move up in the last few days. It's been fairly stable in the 110 to 115 or so range. But I think it's really about the vulnerability beyond just what happens to oil. I think that's the next stage is, thinking about fertilizer, thinking about sulfur. What is the impact which goes beyond just the standard energy and oil price effects that we can see?
Paul, I mean, if you're the U.S. right now, what do you need? I mean, you're going into the midterm in 6 months, so you definitely don't need oil at 110, certainly not at 200. So is there not an incentive to really de-escalate and definitely go for a ceasefire?
There certainly is that incentive. And you talk about oil prices, I think even more so for Trump, he'll be looking at gasoline pump prices in the U.S., and we're close to $4 a gallon as a U.S. average. That's a bit of a psychological marker and something that Donald Trump certainly won't want. We're seeing fertilizer prices go up, and we're seeing farmers in places like Iowa complaining about that. So it is a really big problem for Donald Trump. So he has that incentive to de-escalate. The problem is he needs to claim victory, and I think if he stopped right now, that would be difficult. Or a lot of people, his critics in the U.S. especially, would turn around and say, what was the point of this war? We aren't. Yes, you've degraded Iran's ability to produce ballistic missiles, and you've pretty much destroyed its navy and large parts of its military, but, is this really a victory? So I think he needs to get to that point where he's satisfied that he really can make this look like a win. And obviously he has to reopen Hormuz and make sure that the strait is fully opened to commercial vessels.
I mean, it's also a game of numbers, I guess, because the anti-ballistic missiles cost so much more money than the drones. Do we know or understand the capabilities, and how are the Gulf states reacting to all of this?
Yeah, that's certainly the case. There are huge asymmetries in warfare like this, where the interceptor missiles you're using cost multiples of what the offensive projectiles cost. Iran's ballistic missile firings, let's say, on the Gulf and on Israel have dropped overall since the first few days of the war, although those are still happening. We've seen ballistic missile attacks, bad ones that injured more than 100 people in Israel over the weekend. But it's these Shahed drones, which give or take cost $20,000, that are a big problem at the moment. Iran is probably still able to produce those even during warfare because they're pretty rudimentary. They're difficult to detect. They don't cause as much damage as ballistic missiles, luckily, but they are able to cause fatalities and quite a bit of damage. That's a big worry for the Arab Gulf states and Israel.
And see, I mean, this has led to a massive repricing of what central banks will do, right? So there's almost no cuts on the table at the moment for either central bank. But it does seem that the Bank of England and UK gilts are taking the brunt of this because of the inflation situation.
Yeah, exactly. I mean, if we're looking across the central banks, we have to think about what are their mandates, and I think that gives us a good idea of which ones are most likely to shift. And then, of course, what is their starting point in terms of inflation for the US being above target for 5 years, but also for we know that the Bank of England has been very concerned about inflation stickiness. Now, the big turnaround, is, of course, is that whereas for the Fed, cuts were expected, most people are expecting just a pause for this year. For the bank, we've shifted from cuts right over to hikes. Of course, that's going to see the brunt. And that's really been at the front end. The next stage is obviously to see what happens at their 10-year point and beyond, if there's going to be any moves on the fiscal side. So there are still, I think, some stages to go through before the market can really say we have fully absorbed what the shock is and we're being a little bit more realistic about what's to come.
I mean, is it almost impossible at this point for them to look through this? Again, it's a supply shock, so it's not evident, how they deal with this.
This is the worst nightmare for central banks in terms of that dilemma. Certainly from our perspective, what we think is going to happen is that there's likely to be hikes across the ECB and the Bank of England, and then you get into 2027, all that demand destruction really starts to play out, and then we could see some cuts coming through. But certainly for 2026, this looks like a really challenging year and a big turnaround from what investors were expecting this year to be. So that I think is a big hit.
Seema, I mean, do you have any concerns also about the consumer? I mean, the U.S. consumer, which we talk about on a daily basis, is really propping up this economy. I mean, with the headlines, with inflation, with gasoline prices, is there a worry that they really take a turn for the worse?
Well, so consumer spending was expected to be a very important part of the growth story for the U.S. this year, and that was going to be helped along by the OBBA fiscal stimulus. Now, with oil prices, gas prices where they are, you do get to a point that it almost cancels out the benefit from the OBBA. But overall, comparing the US over to Europe, it's a little bit different because we have got that fiscal stimulus in play in the US. But it's worth remembering that in 2008 is when gasoline prices hit about $4 a barrel. That's what really accelerated recession fears. So certainly there's many numbers that we need to keep an eye on.
Paul, when you look at some of the mediators, so again, European nations have been very reluctant to enter this conflict. I don't know whether they'll have to be drawn in, significantly at some point. But do we know if China's getting involved, or at least trying to mediate things and take the temperature down?
To some extent, a lot of countries are trying to mediate, but it seems like it's at a low level at the moment, and it's not getting very far. Certainly, China's been talking to Iranian officials. European countries have been talking to Iranian officials too, and the likes of Turkey have, and Gulf Arab states, Oman has. We've reported that Saudi Arabia has. It's not making much headway, though, and all sides, let's say all three sides, Israel, the US, and Iran, are sounding very belligerent still. And for all Trump's, as you said, 1 in every 2 times talking of de-escalation, on the whole, it's still very much that this war will continue. That's the message from all sides. There's no backing down from Iran, and there's very little backing down or sense of backing down from the US and Israel at the moment. So all the warring sides seem to think that they can and should continue going for a while, for at least a while longer.
I mean, could it be months, or could it be even longer than that?
This is a big, big question. I mean, for Iran, this is an existential question. They see this war as something that is trying, an attempt by the US and Israel to topple the Islamic Republic. So I suppose you could say that time is on Iran's hands. You could almost say it's a bit like Ukraine when they're facing the invasion from Russia. It's existential. So they will keep going indefinitely. Trump is a big question. This market's chaos is something that, as we've mentioned, hurts him a lot. It hurts him far more than it hurts Netanyahu back in Israel. So Trump could be the key to this. It's, in some senses, it could be the point at which the pain becomes too much for him and his administration, and he says, "Okay, we've got to end this thing and take the off ramps."
Seema, what's the likelihood? Because we talk also a lot about the Asian economies really suffering with this price of oil. What's the likelihood that we could see a global recession because of this?
Well, so when we had been putting together scenarios, our worst case scenarios, you get that multi-quarter stoppage in the Strait. You see oil prices above the $125 a barrel to the top point. We don't really know where it can go to, and that's when you start to think about global recession. Now, through this, the US is still the most contained, the least vulnerable, and Asia is looking like the most vulnerable, China being the exception. So there are just, I think from a global picture, the Asia story is probably key to deciding whether or not we are approaching a global, very negative situation or not.
Okay, thank you both for joining us. A terrific way to get us started this Monday morning. Seema Shah, Chief Global Strategist at Principal Asset Management, and Paul Wallace, our Middle East and Africa Managing Editor. Coming up, we'll talk to the President of the European Bank for Reconstruction and Development about the impact of the Iranian conflicts. That's coming up next, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Burke.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
The chief executive of UBS says energy prices are likely to stay elevated as investors digest the impact of the war in Iran. Well, Sergio Armotti was speaking exclusively with Bloomberg at the China Development Forum in Beijing.
This is basically the biggest topic we have been discussing lately. Of course, the good developments of China are somehow on the side for the second. But, you know, when I go back to that, I do believe that China will continue to have a pretty good growth driven by innovation and the desire really to address also the topics of climate through innovations. And so, but in a sense, you know, that kind of growth may be derailed by what's going on right now in Iran. Energy prices are likely to stay high for the foreseeable future, putting some inflation pressure and also some pressure on the delivery chain or on the supply chain, and in that sense the situation is a little bit unstable.
We're into the fourth week of this war with no end in sight, really. There's ultimatums out there. There are surely mitigation plans being put in place by businesses. What do you see as the direct cost to your business and your clients right now? And with no end in sight, how does that translate to mitigation advice?
But we saw clients already diversifying their portfolios early on this year. You saw much more dispersion in the way they were looking at maybe shifting away from more the AI technology to a more diversified portfolio. That was a good move, considering what we see in the last few weeks. At this stage, clients are still, broadly speaking, calm. We don't see any major shift in asset allocation, but of course, you know, this pressure that I mentioned before on the economy will start to weigh into the market.
Well, that was the UBS CEO, Sergio Armotti, speaking exclusively with Bloomberg's Stephen Engel. Now, surging energy prices from the Middle East conflict, of course, are threatening to cripple developing economies. In response, the European Bank for Reconstruction and Development says it's in talks with nations across the region and Africa to provide additional support as trade and remittance flows face major disruptions. Well, I'm delighted to be joined now by Odile Renaud-Bassot, the president of the EBRD. Thank you so much for joining us, as always.
Thank you.
I mean, when you look at what's happening in the Middle East, how are you monitoring developments, and what kind of impact do you think it will have on countries where you operate?
So, of course, we are monitoring very closely the development. There is a high level of uncertainty, so we need to work on the basis of scenarios and so forth. But we already see quite a significant impact on some countries. And of course, I mean, the impact is quite different from countries in the very close neighborhood. And I'm thinking, for example, particularly in Lebanon, which is the country now really in the middle of the war, with a huge displacement of population, a huge economic shock. So really a very difficult situation. Countries very close by. I mean, in like Jordan, Egypt, West Bank, for example, are also very directly, impacted by the cost of energy, but also the possible impact on tourism, remittances. These are countries which are very highly dependent on Gulf remittances from the Gulf, and so they may be directly impacted by this channel of contagion. But also, more broadly, all countries dependent on oil and gas will suffer from the impact of the increase of prices. Our assessment is that if oil prices remain above or at $100 barrel for a long period, extended period of time, this has an impact on inflation of plus 1% and a reduction of growth of minus 0.4%. And this is what we expect on average on our countries of operation.
Odile, I mean, how do you see, again, what's the way forward for Lebanon? I mean, it's heartbreaking, really, what's happening with the displacement of the population. This is, again, a country that was really slammed economically for things that have happened in the past. How do you see that, you know, can we talk about reconstruction yet?
It's very early. I think what we are trying to do is to continue to support private sector businesses which have, because people need to, for example, we still have some projects on the country for small businesses, private sector and so forth, but it's very challenging. And of course, this needs a political situation and a political solution with, because it's, part of the country now is really under heavy bombing, pressure, military pressure, and so forth. So it's really challenging, and there is a huge need for humanitarian support.
So what kind of support or actually, discussions are you having with your partners on the ground?
So what we are thinking about how we can support our clients in the most affected countries, providing emergency support, liquidity support, working capital, sometimes where our clients need some restructuring, this could be considered also. So really working on a toolbox that can help addressing the situation from private sector businesses and possibly also state-owned enterprise in the countries affected. And it's, country directly impacted, but also a country like Moldova, for example, which is far away from the conflict, but it's very dependent on oil and gas from outside, will be impacted by the increase of prices.
So what have you learned? I know you've been very involved also in the war in Ukraine. What have you learned from, I guess, COVID and the war in Ukraine that could help some of your clients, if not weather the storm, better prepared? Because we also have, there's a huge amount of debt, and so a lot of the governments across the board just don't have the money to maybe be able to support the population like they have in the past.
Yes, exactly. So I think what is important is to react quickly, to use, a multilateral development bank like us can play a counter-cyclical role. So we are there for the long term. We are not going to withdraw and we are going to continue to provide support. And for government, when you're talking about how to support and to weather the impact of this energy price shock, you need to have very targeted measures, because a lot of governments do not have a lot of margin of maneuver, and you need to find and to reflect about targeted measures so as to limit the impact, as much as possible, the impact of the shock.
If energy prices, persist at these levels or go even higher, is there a figure or a timeline where we should really do the alarm bells? Like if the price of oil goes to 150 or 160, or the price of fuel and gasoline? That would have a huge, that would be, I think, beyond the alarm bells. As I was saying, with a price staying at $100 a barrel, the impact on the growth is quite significant. Yeah. So if it goes much beyond, this will have, and the issue is an issue of price, but also a shortage of energy. So you see a situation in Asia where already there is some restriction on the use of oil and gas in order to limit shortages, the risk of shortages. And we're also talking about fertilizer. There are second-round effects that maybe we'll find out in the next couple of weeks and months of how deep the crisis could be. Yes, the impact on fertilizers is already quite significant, because 35% of fertilizer, product for fertilizers production were coming through the Strait of Hormuz, and this has a huge impact. And countries like Kenya, for example, depend 30% of their fertilizers coming from, Gulf production. So the impact can go quite quickly. Having in mind also that we are in spring, it's a season for agriculture where you need fertilizers, so this may have an impact also, accentuated by this fact.
Odile Renaud-Basso, thank you so much for joining us. That is, of course, the president of the European Bank for Reconstruction and Development. Coming up, Iran doubles down in the face of threats from President Trump, so we'll discuss how the Iranian people are reacting as well. That's next, and this is Bloomberg.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The global sell-off deepens. Stocks, bonds, and gold all falling as the U.S. and Iran step up their rhetoric. President Trump threatens to attack Iran's power plants unless the Strait of Hormuz is reopened by tonight. Iran doubles down with fresh strikes across the Persian Gulf. Plus, Italy's Poste makes a €10 billion bid to delist Telecom Italia, turning from its biggest shareholder into its owner. So the U.S. and Iran are trading threats as the conflict enters its fourth week, showing no signs of de-escalating. Now, the U.S. Treasury Secretary told NBC that the U.S. is trying to destroy Iran's fortifications along the Strait of Hormuz.
Every day, we are taking out their missiles, their missile systems, and the factories that build those missiles. And now the General Kane, Secretary Hegseth, are leading a campaign to destroy all the fortifications along the Straits of Hormuz. Again, they're not mutually exclusive. Sometimes you have to escalate to de-escalate.
Well, with us now is Roxanne Farmayan, a lecturer at the University of Cambridge. Thank you so much for joining us. Professor, so first of all, I mean, where are we in this war? It seems that, I don't know whether, the U.S. thought this was going to end much quicker, and to me it's unclear what the U.S. are trying to do now.
Well, I think there are several problems with bringing this war to an end. One is, I think it's very clear that Israel and the U.S. have different goals, and that is one of the issues I think we're seeing over and over again. The U.S. is looking for an off-ramp. They're anxious to declare victory, I think, and de-escalate. And that is not what Israel wants. Israel wants to destroy as much as possible in Iran and reduce its power so that it's no longer a threat to the plans of Prime Minister Netanyahu.
But Professor, I mean, listening to Donald Trump speak, it seems that, I don't know whether he changes his mind, but it's 1 hour we want to de-escalate, and 2, you will incur the wrath of the U.S. if this continues. So is there really de-escalation progress, or at least, diplomatic talks to try and bring it down?
Well, I think it's one of those situations which we've seen over and over again. The United States goes into the Middle East and then it can't seem to find a way to withdraw. And it's something that makes certainly President Trump extremely angry that he cannot seem to locate that sweet spot in order to leave. So no, there are no negotiations going on. And as far as I understand, there are demands that are being put forth by Iran at this point, saying various things, that war has to be off the table, that all of the American bases have to be withdrawn. There are very specific elements that are saying no ceasefire. The end of the war is what we're asking for, and I don't see that happening very quickly.
How likely is it that we see regime change in Iran?
I think very unlikely, at least for the moment. The government is very, very strong. It is multi-layered, and it has made contingency plans so that if its top people get taken away, it has others in line to take their places. And I think we can say that regime change would be possible if the pressure on the outside reduced and the Iranian people themselves could get an economic situation that they could start flourishing in, and that would lead to them then saying, we really don't like this government very much, we're going to change it. But as long as there are enormous sanctions on the country, which pressures every level of the population, there simply isn't going to be regime change.
Yeah, I mean, there's also, a huge problem with who has the weapons, because we saw big protests and uprising at the beginning of the year, and they were quashed without impunity from the government.
Yes, I think that is, this is a brutal regime. I mean, it is certainly willing to impose enormous cost on the population. And we've seen this not just in this most recent protest. The Green Movement was an extremely good example of that back in 2008. So I think that part is definitely in the hands of the government. On the other hand, I think certainly it has weakened in this process, and I think the feeling of the population itself is more and more that they've got to rid themselves of this economic malaise, more than even the structure of the government. I think their view is more, we do not want to have civil war, we do not want to have chaos, we want to improve our economic situation, and that will lead to political improvements.
But Professor, I mean, if this is a fight for survival for the Iranian regime, how are the Gulf states also thinking of this? They have their economies squashed so far because of the drones. Can they live with a kind of, diplomatic agreement?
Well, this next part of, we're all waiting for what happens this evening. And if Trump does go ahead and attack the electrical grid in Iran, it has said it will attack the electrical and water desalination grid in the Gulf. That would be a whole game changer. These are deserts. They're places that people completely depend on electricity and water that is not there. So that would actually change the whole profile of the Gulf. I think they're very worried about that. I imagine the pressure they're putting on Washington at this point is high. But I think it's, Yeah, it's one of those things that he feels, I think, that he cannot let Iran have an upper hand in this. And so we see this tit for tat, and it goes on.
I mean, Oman played a very important role,
It did.
and now a little bit less because they didn't really get anywhere. Could China play a bigger role to mediate, or at least, again, just try and take the temperature down?
Well, I think that's a really good point, and also Russia. I think both of them are gaining quite a bit from this war, particularly Russia, as it's able to amass enormous amounts of income with its oil now off the sanctions list. And I think both have weight they can push with Trump and are considered honest brokers with Iran. So I would say this is going to have to become a much different kind of negotiation and moderation, if you will.
Why do you think the U.S. entered this war?
I don't know. In many ways, I don't even think of it as America's war. I think of it as Israel's war. And I think that the deal that was on the table during the negotiations, this last negotiations in Geneva, was actually a fantastic deal, better than Obama had received with the nuclear deal of 2015, the JCPOA, and really would have possibly delivered Trump the prize he's always wanted, the Nobel. But I think there was an element of wanting to work with Netanyahu on this, and Netanyahu has been pushing this war. And so I think, unfortunately, there was I would describe it as a real misstep going in.
Yeah. I mean, there is, some people, there's a line of thought that's saying, look, with gasoline prices hit $5, that's when the U.S. says, look, we've done our job, let's get out. I mean, is that a possibility, and would that really make a difference?
I think not only the gasoline price, I think the drop in the stock market. I think we're seeing gilts going through the roof. I mean, I think there's several elements that really are close to Trump's heart and that he watches very carefully. And one of those is going to, I think, finally tip the balance. He cannot possibly imagine resuscitating his party for the midterms if the economic situation is like this. And it's going to have knock-on effects with the food and fertilizer, as you were speaking about.
Thank you so much for joining us.
My pleasure.
From Ariane, the lecturer at University of Cambridge. Now, the head of the International Energy Agency has also described the energy market disruption as equivalent to two major oil crises of the 1970s and 2022 gas crisis all put together. Joining us now is Will Kennedy, Bloomberg's EMEA news director. So, Will, thank you for joining us. What happens now in the oil market?
Well, a lot will depend on what happens when this self-imposed deadline from President Trump passes at the end of our day today. I think it's fair to say that the eyes of oil traders will be firmly on what happens next. And I'm not sure there's a good oil market scenario in either case. If Trump decides to follow through on his threat and strike at energy targets inside Iran, we've heard from your previous guests that Iran is likely to retaliate against energy infrastructure across the Gulf. It's done that already, but it's threatened to step up those attacks, and that will be very bullish for the oil price. Even if he doesn't, there's no indication that Iran is going to concede to his demands and open up the Strait of Hormuz. And as we've discussed several times, Francine, the longer the strait stays closed, the more bullish it is for oil, the more stress we put on the energy system globally, and the more we'll see energy prices, not just in oil, but in oil products, continue to rise.
Well, how high could oil go as the disruption looks set to continue?
Well, I'm not going to give you a forecast, but we've seen some pretty hair-raising figures out there. I think that there was a story that said that Saudi Aramco, the big Saudi Arabian oil monopoly, had done its analysis and said that it was worried that oil could go as high as $180 a barrel. We've definitely seen those sort of figures in the 150 to 200 range bandied about, and while those are extreme figures, higher than crude has ever been, I think a lot of people in the market would say that if this continues for any length of time and strikes on energy infrastructure continue, that's inside the realms of possibility.
Will, what about gas?
Well, obviously, this is the other big story from the war so far. Last week, we saw the world's biggest LNG plant in Qatar hit by missiles from Iran. There was a pledge to step back from those kind of attacks, but that seems to be back on the table after the president's statement over the weekend. If we see any more attacks on Ras Laffan, on other gas infrastructure in the region, we could continue to see those prices go higher. And the important thing there is the length of time it takes to rebuild that gas infrastructure means the impacts will last months, years, and there's no quick unwind for this situation.
Well, thanks so much, Will Kennedy, there, Bloomberg's EMEA News Director. Now, Italy's Poste has said, of course, it will launch something. Well, Italy's, let me get this right, because it's one of the biggest stories that we're doing today. Poste is bidding 10.8 billion euros for full control of Telecom Italia. We'll have a full roundup of that. Of course, the move would fold Telecom Italia's operation into Poste's retail network, creating possibly this combined entity with about 26.9 billion euros in annual revenues. We'll have plenty more of that after the break. Also coming up, New York's LaGuardia Airport has closed to incoming flights after a fatal crash on the runway. We'll also have details on that next. And this is Bloomberg.
How the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Italy's Poste has said it will launch a voluntary public offer worth 10.8 billion euros for the former Italian phone monopoly, Telecom Italia. Well, joining us for more on this is Daniele Lepido, Bloomberg's senior reporter. Daniele, thank you for joining us. So what does Poste Italiana's bid mean for the future control of Telecom Italia?
Yeah, good morning from Milan. Yeah, it's another day with Telecom Italia, and this saga is never over. Yes, basically it's a kind of full back to the state control of one of Italy's largest company, and the Meloni government is tightening its grip on Telecom Italia. I would like to remember that the Poste was already the company's largest shareholder, and now with this takeover means that Telecom Italia will become the digital pillar of Poste Italiane, which is one of the country's largest conglomerates.
So why is the government backing this kind of consolidation now?
Yeah, basically they need to have a big platform, a big digital platform to compete with other European and US players, and especially with the merging of nationalism, having, Telecom Italia fully integrated in Poste Italiane could be a big, something pretty important, very important for the company, or in order also to offer more services for EI, for example, and other digital services for enterprises, not just for consumer. Don't think just about consumers and customers, but also for enterprises and data centers, for example.
But Daniele, what changes for consumers and competition in Italy's telecom market?
Yeah, let me say that this move by Poste Italiane could in some way kick off a new wave of mergers because you know that Italy's telecommunication industry is one of the world's most competitive, and so that means that and other mergers could happen. We have 4 carriers in Italy, 4 big players, and the aim of the industry is having just 3.
Daniele, thank you so much. Bloomberg's Daniele Lepido. Now, German conservatives, led by the Chancellor, Friedrich Merz, have secured an election win in a socialist haven as he struggles to gain traction amongst voters nationwide. Meanwhile, in France, the far right fell short of taking control of some major cities during yesterday's municipal election. So let's bring in Oliver Kirk, Bloomberg's chief Europe correspondent, to take us through some of the results. Ollie, good morning. So first in Germany, the victory seemed to soften the blow for the CDU after a stinging defeat in a neighboring state.
Yeah, I think that rather than sort of saying this is a massive victory for Friedrich Merz, the way you've put it is quite accurate. It softened the blow of some of the defeats that he has suffered since he became chancellor about 10 months ago. And we should say this is a candidate, this is a chancellor that is very unpopular, relatively speaking, in Germany. He didn't even get all the votes of his lawmakers in his own coalition on his first day when he was supposed to be appointed chancellor. And that has sort of been the kind of flavor going throughout his premiership. So 2 weeks ago in Baden-Württemberg, that was a much more significant election because it's a much bigger territory. The CDU managed to lose by a couple of points to the Greens, but now we see a little bit of redemption here for Friedrich Merz in Rhineland-Pfalz, where he managed to edge out the Social Democrats that held the seat for 35 years. We should also say, because we watched this with very close interest, Francine, at every state election, the AfD did manage about 20% of the vote, which is notable despite the fact that they came in third, because this is not really, generally speaking, a haven for them that is a stronghold for the AfD. So again, significant in sort of appraising the state elections. There are 5 of these this year in Germany, and really the ones we're going to be focusing on is a little bit later in the year, Francine, particularly in Sachsen-Anhalt, when we'll expect an election there where the AfD may not only win, but may get an outright majority, and that would be yet another blow to the Chancellor of Germany.
Ollie, Marine Le Pen's national rally also missed out on some of their biggest targets. So what does this mean ahead of next year's presidential election?
Yeah, so just getting to the sort of the cities that we care most about, obviously Paris is the sort of crown jewel within France, and that was held by the socialist Emmanuel Grégoire, managed to win that seat, really taking another sort of term for socialists after 2 terms from Anne Hidalgo. So that was sort of the main sort of municipal election that we were watching out of 35 or so thousand that there were across France. But I think the trend across France, what we did see was a rise for the far right, for the Rassemblement National, Marine Le Pen's party, headed now by Jordan Bardella. We did see their popularity increase, but in the second round vote, we did not see them get all the way to the goalpost on many of the key elections in the key cities within France. So it's a bit of the theme we've seen historically within France, where you do see a move to the right, you do see some rising popularity of the RN, and at the same time, not really getting that escape velocity in all of these jurisdictions. That being said, they did win a number of different cities, and it will give them an opportunity, which they have not had since the 1970s when this party was founded, to begin governing and get that track record sort of on display ahead of the 2027 election next year, which is really anybody's game, as you know, Francine.
And Ollie, Denmark goes to the polls on Thursday as Prime Minister Mette Frederiksen seeks a 3rd term. What can we expect there?
Yeah, that's right. So they're going to go to the polls tomorrow to vote in the national election within Denmark. She called the snap election in the wake of what we saw with the sort of disagreement over Greenland. This was really sort of a boost for her nationally. Her polls have been dwindling in the last couple of years, but really this would be her third term. So this would be Mette Frederiksen stepping up to the plate to try to get a third term. They have it pretty much on lock. It is very likely that she will win. The question will be what the coalition will be composed of. The main issue domestically has been a reform on taxes, a wealth tax that puts a 0.5% tax on people that have effectively more than $4 million. That has been pretty controversial within the private sector. But from the EU perspective and the national stage, Mette Frederiksen is a sort of known quantity for the Europeans. She's somebody that's been very hawkish, very defending of Ukraine, but also is a sort of an interesting model of a socialist who is a very strong socialist and at the same time very sort of strong on immigration policy. And that's a sort of playbook we're starting to see develop across Europe. But likely she's going to win another term when they go to the polls. The question will be in what kind of coalition she'll assemble the government.
Ollie, thanks so much. Ollie Crook there with the very latest, of course, on some of these elections that have been or that will be. Just the Danish election is actually tomorrow, not Thursday, so I stand corrected. Now, New York's LaGuardia Airport will remain closed until at least 2 p.m. local time. That's 6 p.m. London. That's after an Air Canada Express plane collided with a vehicle shortly after landing, killing the pilot and co-pilot. Let's get more from Danny Lee, Bloomberg Aviation and Transport reporter. Danny, thank you for joining us. What more do we know about the incident?
Hey, Frank, good morning. So we know that there was a fire truck that was crossing the runway at LaGuardia Airport late night on Sunday and crashed into a Air Canada regional jet that was landing. And unfortunately, as said, 2 pilots have now died. We don't know any more about the extent of injuries on board. We had 76 passengers on board the aircraft overall. But yeah, this is yet another fatal commercial aviation accident in the U.S. at a time when authorities are trying to modernize and boost safety.
Yeah, and Danny, as you're saying, this is it feels like it's just the latest accident hit the U.S. aviation industry in the last 15 months.
Yeah, that's right. I mean, the string of accidents that have taken place, obviously we have to go back to the most notable case, the American Airlines jet that crashed, collided into a U.S. military helicopter back earlier last year, and then also the UPS crash. So clearly there will be a focus on authorities to try and quickly understand what went wrong in this latest incident. We do have National Transportation Safety Board officials being dispatched to the scene. But already when you try to look and understand what has happened, there is some audio on the internet relating to the air traffic controllers being remorseful for what has happened. But it's going to be a key thing to try and get a handle on what has happened, because for now, one of the US's busiest domestic airports will be closed until 2 p.m. That's going to affect many hundreds of flights in the meantime.
Danny, thanks so much. Danny Lee there, Bloomberg's Asia Aviation and Transport reporter. Now, Bloomberg understands that the chief executive of the world's largest oil-producing company has withdrawn from a major energy conference in Houston as he deals with the situation in the Middle East. The Aramco CEO, Amin Nasser, had been due to appear on stage at CERAWeek, but sources say he will no longer take part. Aramco has had to reroute much of its oil because of the effective closure of the Strait of Hormuz. And European Commission President Ursula von der Leyen is visiting Australia this week after she said a trade deal between the two sides is in the final stretch. Well, von der Leyen will travel to Canberra to meet with Prime Minister Anthony Albanese, although it has been confirmed if a deal will be signed. Well, Australia and the EU have been negotiating over a free trade agreement for more than 8 years. And the Volkswagen CEO has told the German newspaper that the restructuring process at Europe's largest automaker will continue even as its order backlog rises. In an interview with Bild, Oliver Bloom has said that to avoid costly overcapacity, the company is applying clear manufacturing cost targets to all of its plants, while Bloom adding that Germany can learn a lot from China, hailing the country's systemic approach with so-called 5-year plan. And finally, Lionel Jospin, the former Prime Minister of France, has died, age 88. That's according to the French news agency AFP. Now, during his 5 years in office, which ran from 1997 to 2002, France recorded its fastest economic growth rates in a quarter century, outperforming the UK and Germany. Jospin was also known for introducing a 35-hour work week. While AFP reports that Jospin died on Sunday, it did not immediately provide a cause of death. So, of course, there is quite a lot going on in today's market session. If you look at gold, for example, it's fallen for a 9th day, again, as the war in the Middle East spurred a broad sell-off across markets. Gold actually plunging as much as 8.8% to just shy of $4,100 an ounce. Now, the metal, in fact, has shed more than 20% since the war in Iran began, with part of the losses explaining by a dash of cash for investors ditching their relatively liquid assets. Now, expectations of higher interest rates, but also expectations of a stronger dollar have added to headwinds for gold, with non-yielding bullion looking less appealing when rates remain high. Amongst the other things we're watching, of course, there's also Brent. It was above 110, also a WTI in the U.S. Overall, look, it's, fears of this possible escalation in the war in the Middle East are driving sharp declines in bonds and stocks after the U.S. and Iran seem to be toughening their rhetoric. Tomorrow on The Pulse, we'll have an exclusive conversation with the Telecom Italia chief executive following that takeover bid by Poste Italiane. That's at 9:30 a.m. London time. Coming up, Sheryl Sandberg, the former Meta COO, is on Bloomberg ETF IQ at 4 p.m. London time. Up next, it's Bloomberg Surveillance, and this is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Guerrero.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Welcome to Bloomberg This Weekend. I'm David Guerrero.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
The moves that we're seeing in the front end of the curve, absolutely nothing shy of spectacular.
The central banks aren't taking any chances. It is now leaning towards hikes more than cuts.
We still think the next move is a cut.
What's going to happen? And the answer is, we don't know.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg surveillance starts right now. Coming into Monday, facing an ultimatum. The US threatening to strike power plants unless Iran reopens the Strait of Hormuz, keeping oil at multi-year highs and gas elevated as the war enters week 4. The energy shock morphing into a bond market rupture, sending yields even higher. We begin this hour with the president's ultimatum, posting Saturday evening. President Trump writing, if Iran doesn't fully reopen without threat the Strait of Hormuz within 48 hours, the U.S. will hit and obliterate their various power plants. That deadline just hours away.
13 hours, 44 minutes, according to the president, when potentially we have this deadline, according to him, that there will be a serious escalation if the Strait of Hormuz is not opened. What is so interesting is it came over the same course of the weekend when Friday evening after 5 p.m., the president actually said they were looking at winding down, which is why you have Tehran, Gulf countries, and financial markets, Jonathan, on edge.
In this market right now, in crude, we're pricing higher for longer. This is a change. Let's check it out. Check out the front end of the futures curve and compare it to where December is trading right now. And you'll see the bigger move is taking place at the longer end of the curve. The December contract coming into this war, trading in the 60s. It's now trading close to 90 so far this morning. And the larger move at the very back end of the curve, which tells you at the moment for this year at least, we're pricing higher for longer.
Yep, higher for longer when it comes to energy prices. That potentially means higher for longer when you look at the gasoline pump. I checked AAA this morning. We are just a hair, a smidge away from $4 a gallon across the national average. And all of this, Jonathan, is for the fact that people are starting to wake up and realize even if the Strait of Hormuz does become open, the damage is done. IEA's Fatih Birol said more than 40 energy sites across 9 countries in the Middle East have been severely or very severely damaged. It is going to take months to get them back to operation.
We've been tracking this as follows with the following framework. Take the energy shock, push it through the bond market. Energy shock, bond market rupture. Check it out, 2s, 10s and 30s. Yields at the front end of the curve rising for 5 consecutive days. In 16 trading days, we've had a 60 basis point move and we're just short of 4% on 2s this morning. Higher for longer in the energy market, higher for longer in the bond market.
You have to think, is this where potentially the president starts to wake up and feel yippee? Remember, it was Liberation Day. It was around these levels when he started to get concerned about his policy. He didn't like this idea of the question of the Trump put, would you reverse policy? The problem he has now is he is only one party to this conflict. And if he wanted to reverse it, he is going to need the Gulf Arab countries to get on board, the Israelis, and of course, another party, and that's the Iranian regime.
We've got a lot to work through this morning. We're kicking off Monday morning with futures, negative 0.75% on the S&P. Coming up this hour, Jeff Yu of BNY with stocks under pressure. Norman Rule of CSIS as President Trump gives Iran an ultimatum. And Michael Hay of SocGen on how crude could hit 150. We begin this hour with our top story. President Trump threatening Iran with an ultimatum to reopen the Strait of Hormuz by later this evening. Bloomberg's Jemana Basenji joins us now for more from Dubai. Jemana, that deadline just around the corner.
Yep, and the entire region is on edge. I will say it was interesting that we heard from the U.S. Treasury Secretary Scott Bessent over the weekend, and he said sometimes it's necessary to escalate in order to de-escalate. But what we're seeing right now is who has escalation dominance. So essentially what we know is President Trump put out that Truth Social post on Saturday evening, 7:45 p.m. Eastern Time, threatening Iran to reopen the strait with no threats. And if they did not follow through on that, then the U.S. would not hold back at striking Iranian plants. Now, Iran was quick to respond the next day, and they said in turn that if the U.S. followed through on that threat, they would then strike back once again at key energy infrastructure in the region, alongside information technology and desalination infrastructure as well. And let me just spend a moment on that, because to what Anne-Marie was saying, if you look back, and the war has been going on for 24 days now, the IEA are saying there are 40 sites, 40 energy sites in the region up until now that have been damaged or severely damaged by the Iranian attacks. They're also saying that desalination plants could be a target here. That would be a game changer for the region, because depending on which country that you're looking at, about 70 to 90% of the water is derived from these desalination plants. So there is a lot of nervousness about whether President Trump is actually going to follow through on that ultimatum. It translates to around middle of the night over here in the region. So we'll see what happens over the next 24 hours. But irrespective of that, I think what's become clear from all of this is Iran have realized the leverage that they have over the Strait. And it is not what they say shut, it's effectively under their control. President Trump is trying to reduce the chokehold that they have over it, but with limited appetite from allies to get involved. You know, we've heard from the NATO Secretary General of the weekend, Mark Rutte. They said that they're working on a plan to help assist the U.S. with the maritime mission. But ultimately, the situation we're in now is it is still effectively shut. And as long as it's shut, you're going to continue to see this upward push on global energy markets. Plus, you have to factor in the ongoing damage that is being sustained at many of these energy sites. And even just this morning, ADNOC, which is the main energy operator here in the UAE, they too are saying that they're going to have to start limiting LNG production. So the knock-on effects are continuing. As we head into another key ultimatum, the next 24 hours will be crucial once again.
The pressure is building. Jemana, stay safe. It's going to catch up as always. Bloomberg's Jemana Basechi there, leading our coverage out of the region as this war enters week 4. She mentioned the IEA. Fanny B-roll in the FT over the weekend. Check this out. Volume of gas cut off is double what Europe lost from Russia in 2022. More oil lost now than the twin shocks of the 1970s. Fanny B-roll calling this, quote, the greatest global energy security threat in history.
It's basically this two-pronged approach what we have right now in terms of LNG being taken offline as well as actual crude barrels, which is why he's saying it's these two massive energy shocks of the past, 1970s most recently, 2022, confounded in one crisis right now.
Here's the view on Wall Street so far this morning. Jeff Yu of BNY writing, investors are increasingly fatigued by the lack of resolution. The risk of further market adjustments is rising, not fading. Jeff is welcome for more. Jeff, welcome to the program. We've seen a major adjustment in energy. We've seen a major adjustment now in the bond market. How far along are we in the adjustment process for equities?
I think no one really knows at this point, and we're looking at EM this morning, pretty much given up all its gains for the year. I think the first phase is pretty much done, and what I mean by that is the overheld positions, the high-performing positions, your careers of this world, they have basically given up this year's gains. But that's the first phase. The next phase is now we look at the impact on balance of payments, the impact on margins. Do we move into an outright correction mode where you've not only given up your gains for the year, but you move into an outright loss and a severe loss? I think that's the next phase where markets are looking at, and we just don't know what resolution even looks like at this point, and I think that's where the focus needs to be.
Jeff, many are shaken by memories of 2022, stocks down, bonds down. What are the risks of a repeat of 22 for the year ahead?
So here's where I'm pushing back against market pricing right now. I look at this morning, 4 hikes from the Bank of England this year. Seriously? Right. So I'll just give you one figure here. The UK savings rate right now is approaching 10%. In 2022, it was barely 2.5%, 3%. So households have been retrenching for several quarters now, not just in the UK, but in Europe. The place in the cycle for Europe is very different compared to 2022, where we still had this post-COVID demand expansion. So that's where I think markets are really pushing the envelope a bit in terms of what they think central banks can do. They've learned their lessons from 2022, 2020. They're saying the right things. So I think central banks are going to be as hawkish as possible without hiking. That, at least, is the impression I got from last week. So I think that's where some correction is needed as well. It's not all doom and gloom, same as 2022.
Yeah, Jeff, I'm with you, because 22 was a shock for the market, not a shock for GDP. This feels different coming into 2026. This could be a real growth shock. At some point, the outlook gets so bad it's bullish for bonds. Are we close to that point?
I don't think we're there yet, because, as you said at the top of the program, they're looking for resolution, but also, what does resolution look like, and what does the supply chain look like up ahead? I'm actually, in terms of prices, I'm looking at food prices right now, less so perhaps in developed markets, but in emerging markets. Again, what has been a high-performing element. Australia has announced that one of the ammonia plants, which is key for fertilizer, supplies 5% of the world's fertilizer. That's going to shut down for
about 2 months. That's going to have a knock-on impact. India, Bangladesh, these countries, large fertilizer producers, they need it as well. India's asking for fertilizer from China. So this is where I think the knock-on effects could drive inflation higher, not just in EM, but globally, and that will feed through down the supply chain into CPI as well, something we need to keep an eye on. So does that actually introduce capacity to cuts rather than not hiking is something that will be uncertain as well.
Jeff, I'm glad you brought that up because it's not just LNG and it's not just crude oil, it's helium, it's fertilizers, and you're looking at the immediate inflationary shock of that. But long term, isn't that also a growth shock?
It absolutely is a growth shock, and as you stated, helium, that's crucial. Japan, I think, announced last week they had about, 2 to 3 months worth of helium supplies left. I think markets want to look at how much helium is in South Korea, in Taiwan. Why? Because crucial to manufacturing chips. And if we think about the AI theme, that's really been driving US growth, global tech-based growth. If that starts to constrain this theme, which until now has been like one of the positives for the global economy, if that starts to unwind, then the growth shock could be larger than expected as well. So again, right now, we're in the phase of understanding what the secondary, tertiary implications are from all of this.
Makes it really difficult to understand the risk reward in equities right now, Jeff. So let's talk about the price of the story. 5%, 6% away from all-time highs. Is that attractive yet to you?
So again, we don't know, where this and how this ends, and we have to define that. So if it's going to be, so put it this way, in terms of scenarios, starting to look attractive, absolutely yes. But if the knock-on supply effects drives up costs over, let's say, a sustained 12 to 18-month period, let's leave the demand side from the household out of the equation for a second. That will impact margins, right? If helium's going to be more costly, if other input prices are going to be more costly, then we have to factor in that discount into equity markets as well. If it's going to be short-term production issues, 2 to 3 months, as has been stated, then I think it's manageable. Anything more prolonged, if we're talking 6 to 12 months, then a discount is needed.
Hey, Jeff, it's going to catch up. As always, Jeff Yu there, FBNY, out of London this morning. We've had the energy shock, the bond market rupture in play, and now we're trying to calculate the growth scare. That's where the market kind of is coming into this week.
And when it comes to the growth scare, you need to think of crude oil and how long potentially these high inflated prices will last. And then at some point, does that trickle down to other parts of the economy, to goods and services? You look where diesel is, it is very elevated right now. And that is going to have an effect on a number of issues. And then you take into account helium for semiconductors and fertilizer for plants. This is why this is going to be incredibly difficult for politicians as well as for policymakers.
Speaking of politicians, gasoline basically at $4 a gallon now on average in this country. That's a big change in the last 3 weeks or so. Equity futures on the S&P negative here by 0.7% on the S&P 500 with an update on news worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Iran is carrying out a fresh wave of attacks across the Persian Gulf ahead of President Donald Trump's deadline to reopen the Straits of Hormuz. Trump delivering an ultimatum to fully reopen by 7:44 p.m. Eastern tonight, after which he's threatened strikes on Iran's power plants. Iran is threatening to mine the entire Persian Gulf, not just the Straits, if the U.S. or Israel attacks its islands or coastline. Here, New York's LaGuardia Airport is closed until at least 2 p.m. Eastern following a deadly accident. An Air Canada Express plane with 76 people on board collided with a fire truck shortly after landing last night. The pilot and co-pilot died in the crash, and 13 people were hospitalized with injuries. And the U.S. is deploying immigration agents to airports to help ease delays caused by a budget impasse. Border Chief Tom Homan says the agents will perform non-significant tasks and won't be using x-ray machines or scanning luggage. TSA employees have gone unpaid for 5 weeks due to the partial government shutdown, leading to lengthy delays at U.S. airports. That's your Bloomberg brief. John.
Yahara, thank you. Thank you very much. More from Yahara later this hour. Up next on the program, escalate to de-escalate.
We have demolished the Iranian capabilities, and every day we are taking out their missiles, their missile systems, and the factories that build those missiles. Sometimes you have to escalate to de-escalate.
A conversation up next with Norman Rule of CSIS, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Three-day slide on the S&P becomes day 4. Equity futures negative by 0.8% following a fourth consecutive weekly loss on the S&P 500, the longest in more than 12 months. The epicenter for the pain, you know it well, crude, WTI and Brent. WTI overnight trading in triple digits, 99 so far this morning, up by 0.9%, up on the month by 40 to 50%. And this stock down on the month by something like 15. United Airlines, the corporate reality check going into the weekend. United put out a statement. Got lots of cash compared to COVID. Balance sheet's good, demand is tremendous. But take a listen to this from them. Jet fuel prices have more than doubled in the last 3 weeks. If prices stayed at this level, it would mean an extra $11 billion in annual expense just for jet fuel. For perspective, in United's best year ever, we made less than $5 billion. The warning from the airlines.
It's getting very expensive, and this is a warning from United Airlines here in the United States of America. These warnings already came almost immediately in Asia from some of their airlines because they feel the energy shock first. They are front lines of energy shock, and now for the airlines, it has gone global in terms of how much more expensive they realize the jet fuel is going to be. You know what that means, Jonathan? Higher ticket prices.
They're planning for the worst and hoping for the best. Bramo will have more on United Airlines when she's back with us tomorrow morning. Look out for that. Under surveillance so far this morning, escalate to de-escalate.
We have demolished the Iranian capabilities, and every day we are taking out their missiles, their missile systems, and the factories that build those missiles. And now General Kane, Secretary Hegseth are leading a campaign to destroy all the fortifications along the Straits of Hormuz. Sometimes you have to escalate to de-escalate.
So here's the latest this morning. President Donald Trump giving Iran an ultimatum to reopen the Strait of Hormuz or have its power plants bombed. And Iran launching fresh attacks across the Persian Gulf just hours ahead of that deadline later this evening.
So they're launching French attacks, and they're remaining very defiant in terms of some of the rhetoric we are hearing out of the country. So they are saying that all energy, information technology, and desalination infrastructure belonging to the U.S. and Israel are targets. They are saying that also they will completely continue to close the strait if this continues. And then this one, Jonathan, caught my attention. The head of Iran's parliament says that any U.S.-linked financial institution holding American government bonds, U.S. treasuries, would be targets alongside military bases. So potentially what they are saying is that if this were to come to fruition, they would start attacking banks in the Middle East and to American partners and Arab partners and Israel if the president comes through with this ultimatum he has.
This has been a feature of the past 3 weeks and change. When we say Iran, who are we talking about? Who actually has a voice? Who is leading this effort right now, this response to retaliation we see across the Gulf? That one person? Someone else? When we say Iran, who are we talking about?
That's a great question, because when the president is asked about this, he says he doesn't even know who is running the country. Obviously, we have the new supreme leader. He is injured, according to reports, and we have not seen him, even though we have had Persian New Year. Normally, traditionally, you would have this video statement or speech from the supreme leader. We only got a written statement. So that is very curious. But when you look at when it comes to the regime, head of parliament, the foreign minister, the president, all of them are out front.
Here's the take from Norman Rule, the former senior U.S. intelligence official and senior advisor at CSIS. He writes the following: if the U.S. executives executes strikes on Iranian power plants, civilian infrastructure would become a primary battlefield and oil would reprice sharply for an extended disruption scenario. Norm joins us now for more. Norm, welcome to the program. Can you help set the stage? What are we set up for later this evening.
Good morning. So 3 weeks into the conflict, a new battle space dynamic has been created. Despite the extraordinary campaign results of the United States and Israel, the Iranian government has survived. So the war has evolved from a Gulf shipping and gas infrastructure crisis into a deadline-driven strategic depth and civilian critical infrastructure contest that openly involves control of the Strait of Hormuz with all energy systems, regional power infrastructure, desalination systems within a potential escalation envelope. Once these systems become explicit targets or even threat objects, you in essence have a situation where the market will now need to price in not only the crude and liquefied threat to natural gas, but also the reliability of electrical systems, water security, repair times, and the higher probability of allied burden sharing of all of the Gulf Cooperation Council partners.
Norm, when the president puts out a statement and has this ultimatum about opening up the Strait of Hormuz, or he's going to go after power plants, do you think that statement would come from the President of the United States if he was unwilling to do so?
No, I believe the President of the United States has a serious intent of taking a greater action against Iran. I also believe that U.S. Forces in the region are more than capable of executing the President's wishes, but they would prefer to undertake these actions when the conditions are most appropriate. Now, they can do whatever the President requires. Fully opening the strait would require a reduction of Iran's UAVs, its drone threats, and probably undertaking more action against the Strait of Hormuz's Iranian infrastructure, and waiting until we have the full contingent of additional Marines and perhaps some additional air assets.
Norm, you've been in the room. The president will have a number of options in front of him. There's reporting over the weekend that he mulls Karg Island, a takeover of that island that's just some miles off the Iranian coast. Can you go through all the options right now you think are being presented to the president?
Well, I'd prefer to avoid all the options, in that perhaps the Iranians are watching, and giving them a school answer may not be the best of ideas, but it's likely that the president's overall approach is to convey to the Iranian government that they're about to lose control and the revenue from their most strategic asset, and that idea is going to ripple through the strategic leadership of Iran's government and compel them to push for negotiations and to make concessions on several points, which is in essence to give up the idea of nuclear weaponization, the enhancement of their ballistic missile program, the Quds Force activities within the region, and to return the Strait of Hormuz to international control, vice their control.
Norm, there is some speculation that a ground operation could be imminent. Can we go into the realm of speculation together and talk about the geography that you know well? How difficult would a ground operation be in a place like Iran?
Well, I'm not sure the issue is of difficulty. U.S. forces are extremely capable. All ground operations have a lethal component, and no one should diminish the threat to U.S. forces. I think you want to ask instead what the ultimate goal might be. What is the purpose? Are we trying to retain territory? Are we trying to send a message to Iran that we can take territory? Are we trying to destroy key facilities? The question is, what message are you trying to send to the Iranian leadership? We've already sent the message that we can destroy anything in Iran. We can control any physical space in Iran. We control the skies, which means we control the ground.
Norman Rule with CSIS. Norm, thank you, sir. Appreciate it. Of course, the objective at the moment of the conversation, taking Karg Island.
Absolutely. That was the reporting over the weekend, that this is what the president is weighing, potentially going after Karg Island. We've already hit, the U.S. military has already hit military installations on Karg Island. Potentially what would be next was taking control of it and then having complete control of the Iranian economy lifeblood. 90% of their crude gets processed on that island.
We often have this conversation, the president backs out when things get tough. Backs away, changes course. Saw it last year. According to so many people in this market, gasoline prices getting closer to 4. No sign of him backing down. Massive moves in rates over the past week. No sign of him backing down. Conflicting statements, yes. A conflicting statement going into the weekend on Friday after the closing bell. Then he said something else on Saturday evening. But ultimately, no real sign that the U.S. military is backing down and backing out.
So Friday after 5 p.m. when I saw the markets closed, and then I also, of course, saw the president's truth, I thought maybe this was the moment he wanted to back down. And then that was completely reversed with his next statement saying that there was going to be this ultimatum to the regime. You need to open up the Strait of Hormuz, relax your control. You know, you have to let every vessel in, not just the ones that you deem friendly, or there is going to be serious consequences. So right now, that is why everyone is on edge.
Right now, futures negative by 0.9% on the S&P 500. Up next, Michael Haig of SocGen on why time is working against oil markets. Plus, Yohara has your morning movers. Mining stocks sinking as the war in Iran weighs on metals.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
For the last 3 weeks, every Monday has started Sunday evening, and it started with this. What's the price of crude? This is the price of crude. WTI and Brent. WTI briefly, triple digits, 99 this morning. Brent crude, let's call it 114, a 50% move in 16 trading days through the month of March. Amazing. That's the energy shock. Here's the bond market rupture. Huge moves at the front end of the curve as we price out easing and begin to price in hikes in certain countries. Stateside, just short of 4% on a 2-year yield, up by 60 basis points in just a few short weeks. And in the UK, up more than 100. That's a major, major bond market move. That's the bond market rupture. Now let's talk about the potential growth scare. On the S&P 500, down every single week so far this month. We're down 5% from all-time highs. Within the S&P 500, refiners up by 17%. Consumer discretionary down by 7%. To what extent have we repriced growth sufficiently for the shock in energy and the shock in bonds?
And you know what, Jonathan? It's not just the shock in energy. It's not just potentially that gasoline prices are going up. We are just there when it comes to $4 a gallon of gasoline, just a hair away, and I imagine it's going to hit that tomorrow. What happens when all this starts to creep through the supply chains? Your food costs, other goods, potentially even services becoming more expensive. And you have to think, central bankers around the world remember just what happened in 2022 when they said this inflation was transitory. Is it, or is this going to be more engrossed in the supply chain?
Big question for Governor Marin of the Federal Reserve later on this morning. The biggest dove on the committee is going to join this program at about 8:45 Eastern time. His first conversation following that dissent, that push for a 25 basis point interest rate reduction at the Fed's last meeting. What's the argument now for lower interest rates with the market pricing in higher rates?
I imagine the argument he will make is actually that this is, and it's not a good one. No one wants to hear that this maybe potentially in the short term is inflationary, but you are that concerned that it is going to be an economic shock to the supply chains, and it's going to be lower growth, and maybe at some point for some of these companies, layoffs.
Governor Marin, 8:45 Eastern time. Don't miss that conversation as we count you down to the opening about 3 hours away. With your morning movers, Yahira has more. Hey, Yahira.
Hi, John. We are seeing mining stocks under pressure this morning as they track gold's decline, down for a 9th straight session and coming off of its biggest weekly drop since 1983. And in silver, we are seeing an even sharper move as you're seeing how rising yields are pulling money out of the precious metals trade. And no surprise, as you gave that market check on oil, that we are seeing oil stocks surging this morning as we continue to see oil push higher. Brent up for a 5th straight session with no de-escalation in sight when it comes to this war. As we've been talking about all morning, Iran striking sites across the Persian Gulf, even as it faces that ultimatum by President Trump to reopen the strait by tonight. And I will say Cheniere Energy is benefiting from an upgrade by analysts at Morgan Stanley, so that stock outperforming up 4.3%. And another bright spot in this market is Synopsys. Shares are up 1.6%. On a reporting that activist investor Elliott Management has built a multi-billion-dollar stake and is now pushing the company to better monetize its chip-making software, because this is a business that is at the center of the AI build-out, yet has not kept pace with some of the broader chip names. John?
Yahira with the latest. Yahira, thank you. More from Yahira later this hour. On our radar this morning, Iran threatening to lay mines across all routes if the Persian Gulf is attacked by the US or Israel. Iranian officials saying, quote, the entire Persian Gulf will be practically blocked. Elsewhere, Iran carrying out fresh strikes across the Middle East in the hours ahead of President Trump's ultimatum to fully reopen the Strait of Hormuz. The UAE reporting new drone and missile attacks overnight. And finally, US allied countries pledging to lead a multinational effort to help secure the Strait of Hormuz.
22 countries, most of them NATO, but also Japan, Korea, Australia, New Zealand, Bahrain, the UAE have come together to answer the president's call to make sure that we secure the free sailing through the Strait of Hormuz.
President Trump previously blasting NATO allies for failing to act, with Rutte saying it's only logical European countries need a few weeks to come together.
So right now they're talking, and he talked about how he is in constant conversation as well with the president. But to that last point you made, Jonathan, this comes after the president blasted NATO allies and saying that NATO is nothing but a paper tiger without the U.S. involvement. Now you see the European allies and some other Asian allies talking about it because they might not have a choice. If energy prices continue to go higher, they might need to do something in terms of this coalition to try to reopen the strait.
It really hasn't been a great start to the relationship between NATO and the US. And I would be more specific, I would say European partners and the United States. Going after Greenland the way the US did at the start of the year, I think upset a lot of people. The comments on the way out of the World Economic Forum questioning how committed their allies were 25 years ago in the war in Iraq and in Afghanistan. and the amount of tours that individuals did, NATO allies, that fought on the front line, shoulder to shoulder, with US military officials, and yet the president questioned whether they were on the front lines at all. And here we are. We don't need NATO, we need NATO. We don't need NATO, we need NATO.
It's a little bit confusing, and to that point, this just might be too much for European allies, especially British troops, which did a tremendous amount of work in fighting alongside American troops in Iraq and Afghanistan. You also have to remember, I believe it was the Vice President, J.D. Vance, who told European allies, this is an individual who obviously has been very critical of the Iraq war under Bush, has said maybe it was the European allies should have had more of a stronger backbone and stepped up to the United States. Well, I think some capitals in Europe are actually saying, we have our backbone, we don't agree with this Iran war, and maybe that is why we are not going to send this coalition.
Let's stay on the energy story. Crude hovering around multi-year highs. Michael Haig of SocGen writing, with each passing day, the market grows more strained. With no resolution in sight, prices could climb towards $150 a barrel in April. Michael joins us now for more. Michael, welcome to the program. Your note was one of the first notes I read to start the week. Scenario B. We're very close to what you call Scenario B. What was Scenario A, and what does Scenario B look like?
Scenario A, first of all, good morning. Thanks for having me. Scenario A was our base case scenario at the start of March. The market was pricing in a very quick resolution to this conflict. So our scenario A was that we see the straits opening up by the end of March, but prices getting up to $125 a barrel. Looks like we're going to have to adjust that, move to scenario B, where we have this conflict continuing through April, and that brings oil solidly up to $150 a barrel.
Michael, are you now pricing higher for longer? That's not just a short-term story, that's a long-term problem.
Yeah, unfortunately, that seems to be the case, because every day that goes by, oil taken off the production makes it harder to come back. Obviously, infrastructure gets more and more damaged. So, yes, higher for longer, I'm afraid.
Michael, this was an issue for the equity market, the issue. I think the source of comfort was we had extreme backwardation in the futures curve. Yeah. And for people who aren't in your world, that just meant the front month of the futures curve was really elevated, but the market was pricing a short-term problem, and we had this steep drop-off through the rest of the year. You see this playing out this morning, the opposite. We're starting to lift the back end of the curve, starting to price in the higher for longer scenario. Michael, this raises the question of demand destruction, so-called demand elasticity. What are the realities for the energy market? When does that destruction creep in?
So, well, there's one thing to not being able to afford oil because the price is too high, and the other thing is not being able to get the oil, and that's the bigger concern. So, generally speaking, from a price perspective, and when we talk about demand elasticities, the oil market is fairly inelastic. That means that when prices go up, people really can't change their behavior that much. So, given the fact we've had about a 50% increase in oil prices since the end of February, that would ordinarily mean, from a price perspective, you would lose about 1.2 million barrels a day of oil demand as people can't afford it. If we go to the $150 scenario, then we'd be talking over 3 million barrels a day of oil demand destruction because of the price effect. But as I mentioned, it's not really just about the price. It's about that some countries can't get the oil. So you're already seeing airlines put on surcharges, cutting flights. You see refineries in China cutting their runs. You see ethanol crackers cutting their output because they can't get the feedstock. So there are some countries in Southeast Asia that maybe have 15, 20 days of oil and product in inventory. So we're going to get to a situation potentially where we get demand destruction because these countries can't operate as normal.
Michael, to that point, we have SPRs around the world. Different countries have their own strategic reserves when it comes to crude. Are you basically talking about the fact that we might have the crude, but it's so dislocated in the market right now, there's not going to be enough refining capacity to, say, turn that crude to diesel or jet fuel?
Yeah, I mean, we're talking 17 million barrels a day that has been displaced. I mean, if you look back historically, we've basically had 30 geopolitical conflicts since the early 1970s, and the next biggest disruption to supply was all the way back in 1973 when we had 7% of oil being removed because of the Arab oil embargo. Now we're talking 17% being removed, so it's a massive difference. So, you know, all you need to do is take that 17 million barrels and say how much can be redirected through pipeline, how much can be we offset through demand destruction, how much can come from the relief from Iranian sanctions on floating oil, et cetera, and you add it all up, and you still have a massive deficit of around 8-9 million barrels a day. And that means that that can't get to the refiners in Singapore, elsewhere. They can't create the product, and that creates the issue for gasoline, jet, diesel, mainly in Asia.
Michael, the way you talk, I'm thinking this is not going to be months. This sounds like a multi-year recovery. Is that accurate?
I don't think it would be as drastic as that, but as each month goes by, we're talking several more months to recover. The market's very resilient and it'll bounce back, and there is plenty of oil out there in terms of spare capacity, generally speaking. So, if by some miracle this was resolved tomorrow, and all the oil came back into the market, we might lose like 1 or 2 million barrels a day because of the shut-ins, because of infrastructure, etc. But generally speaking, going into this, we were in a surplus of, let's call it, about 3 million barrels a day. So fingers crossed this doesn't go on through past April, because I think if we can get through that, by the end of the year, we'll be back to kind of normal.
Michael, this is starting to creep into base metals. Let's just turn from energy to things like aluminum, to copper. We're starting to see some big moves there as well. How far along do you think we are in the process of trying to understand how cyclical the demand for those metals actually is at a time when a lot of people are getting bulled up on these secular tailwinds coming out of technology?
Well, I think, let's think about copper here. We said before this conflict that there was some unusual demand situations going on in those metals markets, given the growth of AI, etc., but also because of strategic stockpiling, because of military spending. So I see a very bright future for those metals from that perspective, because coming out of this conflict, I still believe there'll be a push to do more strategic stockpiling for things like copper and aluminium, just like we have for oil. We'll see more military spending. That's very metal intensive. So, despite the fact that they get pulled down because equities get pulled down, I think their future's pretty bright.
Can we finish on gold? Michael, 20% move so far this month. Huge, huge move. What do you think's behind that move? Is it just an interest rate move driving people out of gold? Is there something else at play?
So I think what's going on there is that we don't have any central bank buying right now. I don't think there's any appetite to do that, where countries are squarely focused on getting through this energy crisis. I wouldn't be surprised to hear reports that some central banks have sold gold in order to subsidize some of the energy issues that they have in their countries. So it's been a big pause, I think, in that buying. That's mainly the reason why we've seen it sell off. ETF flows by themselves couldn't explain the dramatic decline in the gold price that we've seen recently. Of course, some of it is fundamentally based on interest rate expectations, etc. But again, a bit like the base metal complex, I think once we get through this oil situation, and with gold prices where they are right now, I would imagine central banks resume their buying.
Michael, good to see you. Thank you, sir. Michael Haig there of SocGen, working through what's happening in energy, what's happening in base metals and precious metals. Gold down by 5% on the session just today.
This is so interesting when it comes to gold. All these central banks that were hoarding it up. Well, why do you do that? For a rainy day. And potentially they are the ones that are right now out there selling, because they need to move funds around in their government to help when it comes to the energy shock that their consumers are facing.
Right now it's pouring with rain, that's for sure. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Iran has until 7:40 p.m. Eastern tonight to open fully the Strait of Hormuz, according to a threat by President Donald Trump. The president saying if Iran does not comply, the U.S. will bomb its power plants. Iran countering that it will completely close the strait and target all energy, technology, and desalination infrastructure linked to the U.S. and Israel in the region. The U.S. saying it will not reschedule a summit between President Donald Trump and Xi Jinping until the Iran war ends. Politico reporting the U.S. will propose new dates for the meeting after the active part of the conflict is over. Trump had previously said the summit would happen in 5 or 6 weeks. And Cuba says the country is preparing for a possible military assault. The country's deputy foreign minister making the comments as President Donald Trump increases economic pressure on the government in Havana. Trump saying Cuba could be the next U.S. target after what we saw in Venezuela and Iran. That's your Bloomberg Brief, John.
Yahara, thank you. Thank you very much. Up next on the program, upending expectations.
Markets definitely have priced out the Fed easing that was expected just a few months ago. Higher inflation would tell you to raise rates. Lower growth would tell you to cut rates. So maybe you just don't do much.
Up next, Stephanie Roth of Wolf Research, live from New York City. You're watching Bloomberg TV.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Another morning of big moves in financial markets worldwide. A big conversation about 2 hours away. We'll catch up with Governor Stephen Moran of the Federal Reserve, dissenting, pushing for an interest rate cut at last week's meeting when the market is starting to sniff out an interest rate hike. We'll get into that in a moment. Check out the bond market move. Twos at 4%. For the first time since June, up 11 basis points on the session so far this morning. The upper bound of Fed funds, 3.75. And we've got a 2-year yield trading north of 4%. We'll get into why in just a moment. Turn to the equity market with that move. Equities down by close to 1 percentage point in the S&P 500. The Nasdaq down by 1.1. The Russell down by 1.5. Under surveillance this morning, upending expectations.
We've essentially taken out 325 basis point rate cuts from market expectations over the next 12 months. Markets definitely have priced out the Fed easing that was expected just a few months ago. Higher inflation would tell you to raise rates. Lower growth would tell you to cut rates. So maybe you just don't do much.
So here's the latest this morning. Treasury yield surging to 8-month highs. Traders betting the Fed could hike interest rates to combat energy-fueled inflation. Stephanie Roth of Wolf Research writing, the U.S. rates market is too hawkish. We would put nearly 0% odds of a hike versus the market's 30% odds. Stephanie joins us now for more. Steph, good morning.
Good morning.
Priced out the easing, started pricing in hikes. What's going on?
The market is pricing in a much more hawkish Fed that I just don't think is the reality. And if they end up
hiking in the near term, they're going to be cutting pretty significantly following that because they're going to cause a recession.
What do you think's behind this move then?
I think it's a couple things. One, it's a connection back to 2022 because in a similar scenario, we had an oil shock and ultimately the Fed had to hike pretty significantly, but the economy is different. If you look back to then, the unemployment rate was 3.7 falling to 3.5. Payrolls were running at 600,000. Now they're running 0 to 50. And inflation at the time was 5.5%, core inflation, and now it's 3. So the backdrop is incredibly different. There's no way the economy can support this type of energy shock without having some sort of demand destruction.
What is your baseline for inflation for the next 12 months?
We're going to sit on core inflation. We'll sit a little above 3%. I don't think we're going to get maybe 10 basis points boost to core, and then that will probably come off because we'll end up seeing a demand destruction. When you see airline prices rising 12–15%, there's going to be some sort of reduction in demand at that point.
Let's go through the sequencing of things, though. First and foremost, the Fed chair comes out and anchors inflation expectations. Sounds like that's goal number one for him in the news conference. And then people start to speculate whether the Fed shifts to a more symmetrical posture. Basically, the communication is there's more chance, as much chance as a hike as there is a cut. Have we got to that part of the sequencing yet? Because I think that's what we're working through at the moment.
Yeah, I mean, I think towards the end of last week, it was more symmetric around hike versus cut. Now it's nearly pricing in a full hike here.
That's where the market is. That's not where the Fed is yet.
No.
Does the Fed start to entertain the prospect of hiking interest rates to anchor inflation expectations in the next few months? And if they do, from a market perspective, is that something you want to step in front of?
I think they might have to do the opposite because we're getting a real tightening of financial conditions here. So at some point in the near term, they might have to come out and say, we're not really entertaining a hike in this backdrop.
So you think the Fed will squarely look through the inflationary shock of higher energy costs and look at, to your point, demand destruction, which basically means lower growth?
I think they're ultimately going to have to. Maybe for now, they don't want to get too much ahead of it, but rates have moved so much, I don't imagine they're feeling very comfortable with the amount of the sell-off that we've seen. So they might want to come out and more clearly say, we're not entertaining hikes at any point in the near term.
So if they're not entertaining hikes, that means you think we're going to see a cut fairly soon?
Yeah, I think in the back part of the year, it's fairly likely we'll get a cut. September, perhaps December.
This is the communication dance, though, that I think is really difficult for the Federal Reserve. Let's say Chairman Powell comes out and he's got a conversation, an interview this morning with whoever, with Bloomberg Surveillance. He doesn't, I wish he did, but he doesn't. And he comes on the program and he says, yes, this is an energy shock. We're going to look through it. What do you think is going to happen to the market then? They're going to price in much higher inflation expectations over the next 12, 18 months out, without a doubt. Which is why, from a communication perspective, I understand why Chairman Powell came out in the news conference. First and foremost, look to anchor inflation expectations and pretend that he's a hawk, even though it's unlikely he's going to hike interest rates. And that's, I think, the communication problem for the market right now. That's what a lot of people have got to wrestle with. That the headlines coming out of the Fed over the next few weeks won't sound like the headlines coming out of the ECB.
Yeah, I mean, you had Waller out on Friday, who's been one of the most dovish voices out there, stating real concern about the inflation backdrop and the closure of the Strait. But I think ultimately the Fed is going to have to become a lot more dovish in the medium term.
So how many cuts do you think the Fed's going to have to deliver? Let's say 2027. What kind of things are you thinking about now? Off the back of the energy shock, tightens financial conditions, yields go higher. What kind of cuts do you expect in 12, 18 months out?
I think we're talking 2 to 3 cuts. I don't think it's going to, provided that they don't end up certainly hiking in the near term. I think then we're talking recession-type territory. But provided that this all kind of works out and energy prices eventually stabilize, then we're talking about a couple of cuts. There's a legitimate chance, though, this ends the cycle, provided that the energy prices stay significantly elevated through much of the summer. Then we're talking about a more significant risk of cuts.
So coming into this year, everyone's bullish. There's a few reasons for it. Tax refunds part of it, all this tech spending another. Do you see this move starting to upend some of those bullish tailwinds?
At the margin, but I think we're still looking at an economy that's fairly steady, provided that the energy shock eventually in the next couple of weeks, there seems to be some sort of off-ramp, but that's very much hinging on oil prices remaining at or below $100 through much of the summer. So I think that's kind of the way that we think about it. If you see oil prices continue to spike, we're talking about $150 through a lot of the summer, that's where the dynamic changes a lot. But provided energy prices stay kind of around the $100 range, then our estimates on 2% GDP can still remain through the rest of the year.
Stephanie, good to see you. It always is. Thank you. Stephanie Roth of Wolf Research. I think the Fed watchers are scratching their heads, looking at the move at the front end of the yield curve because they know the bar to actually hiking is really, really high. market participants have had a different trade on. They're taking that trade off. So the bond market's been totally whipsawed, and they're facing the prospect of Fed communication changing in the next several weeks, and probably don't want to be on the wrong side of that. Because if the Fed headlines start sounding like the ECB headlines, then you've got a problem if you're on the wrong side of that trade.
Absolutely, and you make the point. Even if Powell was to come out and say, well, you know, we're less concerned, we're going to look through this, what happens to inflation expectations? He almost needs to come out with a little bit more of that tougher talk to keep those expectations in line.
We'll talk to Governor Myron about this. I think if you're not the Fed chair, and if you're not a key member of the Federal Reserve, you have the luxury of saying things that the Fed chair can't. So if you're a governor or a regional Fed president who's thinking, I can look through this shock, we probably need to cut interest rates further down the line, that's a conversation you can have. When you're the Fed chair and your words carry a different weight, first and foremost, as any central bank official, leader, you have to come out and anchor inflation expectations. And that's the sense of what I got from Chairman Powell at the news conference just last week.
And to Stephanie's point, Governor Waller, who we all thought was going to descend, his mind was changed after he realized this strait is essentially closed and not opening up anytime soon.
We'll keep looking at this. Massive move at the front end of the curve, 4% on twos for the first time since last June, just south of that level right now, a move of 60 basis points on the month so far. Unreal. Up next on the programme, Tracy McMillan of Wells Fargo, Mark Short, the former Chief of Staff to the former VP Pence, Ellen Wald of the Atlantic Council, and Colin Martin of Charles Schwab. The second hour of Bloomberg Surveillance just around the corner.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
This is a really uncomfortable time, I think, for investors.
You look at the paper markets, they've entirely disconnected from the physical markets.
This war is far from being resolved in any sort of positive manner.
We may see a de-escalation at some point that allows energy prices to come down.
We got to take stock and try to be prepared for any potential outcomes.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Another Monday morning that started on Sunday evening. Wild swings once again. Futures down by 0.75% on the S&P. Over 3 weeks of trading, we're down by about 5% on the S&P 500. We're down again this morning on the Nasdaq by 0.9. In the bond market, a 60 basis point move at the front end of the curve in just 16 trading days. Up 10 this morning, north of 4% for the first time since June of last year. Off the back of this, WTI overnight, triple digits this morning. WTI and Brent look like this, 98.50 and 112.75.
What we're seeing right now, Jonathan, is the market starting to realize that this might not be quickly wrapped up, even if Iran decides they want to reopen or allow more safe passage of other vessels through the Strait of Hormuz. Why? Because you see a number of energy facilities that are hit. IEA's Fatih Birol said more than 40 energy sites across 9 countries in the Middle East have been severely or very severely damaged. Potentially this means longer disruptions, which means higher oil prices for a lot longer throughout the rest of this year.
Higher for longer in the energy market, higher for longer in the bond market, a tightening of financial conditions, and the conversation shifts. I think in the last week it started to turn. Growth scare. Consensus view of this market, short-term disruption, wouldn't take long. Coming out the other side, you'd see crude prices start to fall off. You saw that in the futures curve. Deep backwardation, i.e. at the front end of the curve, crude's really high, physical market even higher. Further out, the further you look, the lower prices go. That curve's starting to lift at the back end of the curve now, closer to 90 from 60 only a few weeks ago.
Because it will be months until things get back to quote-unquote normal. And amidst all of this, we've really had a roller coaster when it comes to the president's truth account. Friday night, just after 5 p.m., Jonathan, the markets closed. It wasn't a great night for the markets. We're getting very close to meeting our objectives as we consider winding down the operation from the President of the United States Friday, just after 5 p.m. Saturday, 7:44 p.m. If Iran doesn't fully open without threat, the Strait of Hormuz, within 48 hours from this exact point in time, the U.S. will hit and obliterate their power plants. So now we have an ultimatum in the market, and that ends this evening.
That's 13 hours away. And if you're in this market right now, do you want to be long stocks? Do you want to be short crude, knowing that in 13 hours' time, this could go aggressively one way or the other, depending on what the president has to say?
And I think if you're the president of the United States, you do not send out that truth if you are not willing to do that. And there was a lot of speculation and reports over the weekend from the Wall Street Journal, from Axios, that the president is weighing whether or not to fully take control of Karg Island, basically controlling 90% of Iran's oil facility, be that is just off the shores of Iran. Even if he were to do that, though, does that mean that the strait is open? We've been talking about with a lot of analysts on this program, the asymmetric risk of a ship going through that strait, whether it's drones or whether it's mines.
That's the headline risk going into this evening. Equity futures down by 0.8% on the S&P. Coming up this hour, we'll catch up with Tracy McMillan of Wells Fargo with stocks on a 4-week losing streak. Mark Short, the former chief of staff to the former Vice President Mike Pence, discussing President Trump's ultimatum. And Colin Martin of Schwab revising his outlook for Fed rate cuts. We begin this hour with stocks adding to losses as the war in Iran is showing no signs of slowing down. Tracy McMillan of Wells Fargo writing, if the S&P 500 approaches the 6,400 to 6,500 range, risk-reward starts to improve based on expectations that the conflict is measured in weeks, not months. Tracy joins us now for more. Tracy, welcome to the program. We've talked about it a million times on this program. Energy shock, bond market rupture, growth scare. Where are we with the growth scare?
Good morning, John. Yes, so we're at a position now where we think that growth continues in the United States. However, we do see higher energy prices, inflationary pressures starting to diminish that potential growth somewhat through the end of the year. However, we do see this conflict still measured in weeks, most likely, and what that means to us is that there's probably going to be an inflationary bulge that moves through the data around mid-year and then starts to look more comfortable to markets and to the Fed by the end of the year. So we're telling investors to look through a lot of the headlines here and take advantage of opportunities that the market is giving us.
Where do you think value is being created? Where are opportunities opening up at the moment?
Yeah, so we tell our investors that it's important to have a diversified allocation. So that includes equities, it includes fixed income, real assets, and alternatives where that makes sense. Because that gives us the opportunity to sell high and buy low. And right now, those opportunities to sell are in commodities, in energy, in the energy sector, and moving some of those assets from commodities into equities, and within the sectors, from the energy sector moving into financials, industrials, and utilities.
Just getting a statement from the president, Tracy. Anne-Marie's going to go through that statement. The headlines are crossing right now. I can tell you the price action reversing up by more than 1% on the S&P 500. In the bond market, yields were aggressively higher. Yields have pulled off those highs. The 2-year virtually unchanged on the back of this, and crude turning much lower. 94 on WTI, Brent at 108. Anne-Marie, what's the president got to say?
So the president is saying that he's postponing strikes against Iran power plants, that talks with Iran are continuing, and he told the Department of War, what he says, this is the DOD, the Pentagon, to postpone those strikes. He's talking about the fact that they've had talks with Iran regarding how to end these hostilities, and these talks have happened over the past 2 days. He says this postponement, putting a bit of a timeline on it, a different timeline now for the president. He's talking about the postponement will last 5 days and has instructed the entire Department of Defense to postpone all strikes against Iran. Jonathan, this is a major de-escalation coming from the White House.
So let's go through this statement. It's on social media, posted just moments ago, and you could see almost immediately the markets start to turn around. I'll read it in full for you. I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East, based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week. I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. The president in that statement just moments ago. So let's work through the asset classes. A complete turnaround from where we were 5 minutes ago. Start with equity futures. We'll go stocks, bonds, and then commodities. Equity futures on the S&P 500 higher by more than 2 percentage points. A massive move in the equity market. In the bond market, yields were higher at the front end of the curve by more than 10 basis points. Now they're lower by 3 to 387. And in commodities, a huge turnaround there too. We were up. We were trading at triple digits overnight on WTI. Now we're trading at 91. We're down by 7% on the session on WTI. On Brent, we're down by 8.
Remember, Jonathan, coming into this morning, what we had from the president was an ultimatum by 7:44 p.m. this evening that if Iran did not open the Strait of Hormuz, he was going to strike Iranian power plants. And then a ton of rhetoric coming from Iranian officials, especially across X and a number of social media platforms. Now the president is saying, and he's pleased to report, he says, that they've had good and productive conversations. My question is, who exactly is he having these conversations with? But he's saying, based on the tenor and tone of them, they want to take it down, take the rhetoric down, and take the strikes down. He's talking about basically a 5-day period of a détente between Washington and Tehran. A lot of questions about what the Gulf Arab partners have to say about this. A lot of questions if Bibi Netanyahu is on board with this. But at this moment, the president is clearly trying to de-escalate the conflict.
So my response would be, okay, these are the words of the president. Where's Iran on this matter? Who are they speaking with in the Iranian government right now? Is Iran on board? That's the next headline you're waiting for off the back of some of this. Tracy, I'm assuming you're following this conversation right now. Big turnaround in financial markets. Tracy, this is almost impossible to trade. Coming into this morning with this massive ultimatum hanging over this market, and I said before these comments dropped, it's so difficult to be long a market when you know you could get whipsawed in one direction or the other. Tracy, is this sufficient enough for you to take risk this morning?
Yes, we are taking risk. We're actively rebalancing portfolios back into those areas of the market that have sold off. And this is just another illustration of how fluid the situation is and how quickly those opportunities come and go for investors. So it's really important, we think, at this time to have a shopping list ready, and when those opportunities arise, start to invest.
Tracy McMillan of Wells Fargo. Tracy, thank you. Breaking down some of these market moves. Let's go through it again. A few moments ago, the President of the United States posting on social media the following: I'm pleased to report that the United States of America and the country of Iran have had, over the last 2 days, very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East, based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week. I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Off the back of this, a big turnaround in financial markets, starting with stocks. Equities higher by 2.8% on the S&P 500, after being lower by almost 1 full percentage point going into that headline. In the bond market, yields through 4% for the first time since last June, now back to 381 and down by 9 basis points at the front end of the curve. You're seeing wild moves throughout this market. We turn to crude, of course, driving absolutely everything worldwide at the moment. Brent and WTI. Brent and WTI look like this. WTI was trading close to triple digits. It's now trading at 86.88 and down by close to 11.6%. Brent back below triple digits at 99.95 briefly, down by more than 10%, around $100 a barrel on Brent after being close to what, 114?
Yes.
Going into these headlines.
This is absolutely an insane move in terms of the markets across the commodity sphere, as well as also across rates and what's going on in equities as well. The president clearly wants to de-escalate this situation. But Jonathan, I have a ton of questions regarding this Truth Social post from the president. I want to know who he has been in discussion with in terms of the Iranian regime, given the fact that their top brass has been absolutely decimated. And also, if the president is saying he has instructed the Pentagon for 5 days to not strike Iranian power plants and energy infrastructure, does this also mean Israel is on board? Because we saw Israeli attacks very early this morning in Iran. A lot of questions remain. And the president is also talking about the fact, Jonathan, that these talks need to continue in a good way, an optimistic way for the next 5 days in order for there to be this, I would call, a mini détente. Well, who is talking to who? What sort of timeline? How are they talking to each other? Is there going to be a meeting? Lots of questions.
That's the next headline we're waiting for. What's the Iranian response to the president's declaration just moments ago? This is what we'll do on the program. We'll go through the market moves for you. We'll get you an update from Washington, D.C., and we'll head over to the Middle East and hopefully touch base with Jumana Basenchi in a few moments' time as well to find out what the Iranian response might be to a statement like that from the President of the United States. In the meantime, let's get you an update on this and more for your news worldwide with your Bloomberg Brief. Yahira joins us now for more. Hey, Yahira.
Hi, John. As you were discussing a de-escalation in the war with Iran, President Donald Trump posting on Truth Social, the United States and Iran have had very good and productive conversations regarding a complete and total resolution of our hostilities. I have instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure over a 5-day period. But ahead of that, EIA Director Fatih Birol saying more than 40 energy assets across 9 countries in the Middle East have been severely or very severely damaged by the war. Birol adding the damage to oil fields, refineries, and pipelines means it will take some time for them to come back online. And another top story here, New York's LaGuardia Airport is closed until at least 2 p.m. Eastern today following a deadly accident. An Air Canada Express plane with 76 people on board collided with the fire truck shortly after landing last night. The pilot and co-pilot died in the crash, and 41 people were hospitalized. The NTSB is launching an investigation into the incident. That is your Bloomberg Brief, John.
Yahira, thank you. Up next on the program, escalate to de-escalate.
We have demolished the Iranian capabilities, and every day we are taking out their missiles, their missile systems, and the factories that build those missiles. Sometimes you have to escalate to de-escalate.
We're getting that de-escalation this morning. Equities session highs on the S&P 500 higher by 2.7%. Up next, Mark Shaw, the former Chief of Staff to the former VP Pence from New York City this morning. Good morning.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
A statement from the President of the United States shaking up financial markets worldwide. Check it out this morning. I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East based on the tenor and tone of these in-depth, detailed and constructive conversations which will continue throughout the week. I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Coming into this morning, there was an ultimatum hanging over this market. The president looking for an off-ramp.
The president looking for an off-ramp. He chose this off-ramp of de-escalation. He's saying that there have been talks, the first I'm hearing of it, the last 2 days between Washington and Tehran, which is peculiar, of course, because every time you've spoken to the president, you see reporters asking this question. He says he's unsure who's actually running the country. You have made the point, Jonathan, and this is critical. We need to understand from the Iranians, that is the next statement this market's waiting for, about what exactly was discussed. Is this really a 5-day détente, potentially that the DOD will not go after Iranian power plants and energy? Or potentially is this the president just trying to put some optimism back in financial markets?
It's almost impossible to trade this market. Look at these moves. Equity futures up by more than 2% on the S&P. On the Russell, up by more than 4%. The airlines are absolutely flying, forgive the pun, in the pre-market. In the bond market, 2s, 10s, 30s. 2-year yields were through 4%. 20 minutes ago, 381.79. We're down 8 basis points now in the session. And the bigger moves in crude, WTI and Brent. WTI overnight, triple digits. Right now, 88.80 and down by about 10% on WTI. Brent crude down by 9.9. And I have to keep going back to all of this. The statement from the president is one thing. The details matter. Who's he speaking with? Who in the Iranian government right now they're having these in-depth talks that they're so encouraged by? And 2, where's the response from the Iranians this morning? They're the headlines I'm looking for, and I imagine most market participants are looking for as well.
I'm scouring Twitter to try to see what the head of the Iranian parliament, the president, Peshkian, or the foreign minister has to say, because these individuals have been the ones that have been responding to the president's truth over the course of the weekend. Just think about how Friday started, Jonathan. Friday evening, markets didn't do well. The president coming out saying maybe we're going to wind down, and then it was back to escalation in terms of this evening. We're supposed to have this ultimatum.
Let's get to the coverage from the Middle East. Joining us now, leading our coverage, Jumana Basecci. Jumana, whipsawed by headlines. The reaction, please, to this one.
Well, I mean, you know, quite the development and perhaps the tackle moment that markets were looking for. But as you and Anne-Marie were saying, we haven't had a response from anyone in Iran yet. So let's just wait and see whether these conversations that he has alluded to have actually been taking place. And also, as we've been flagged in prior reporting, what the Iranians have been asking for in terms of the outcome that they're looking for from negotiations. In past, they've referenced the fact that they want to get security guarantees, or guarantees rather, that the U.S. will not strike Iran again. And they have maintained that they would like to see an outcome in which they can still effectively control the Strait of Hormuz. Of course, that is an outcome that is unacceptable to the U.S. and also to Gulf states. But that being said, I think, you know, one thing that is clear here is, and we spoke about this last week, the attack on civilian infrastructure, and specifically the Israeli airstrikes on that gas field in Iran, was deemed to be one step too far, a red line for the U.S. And remember, President Trump tried to distance himself from that. The fact that he went one step further this weekend and implied that the U.S. may hit energy infrastructure and power plants in Iran was also deemed to be a red line for Gulf states because of the potential reprisal and the impact that that could have on the region, not just on their energy infrastructure, but also on desalination plants as well. They're buying time here. He's pushing it back by 5 days. But whether this is going to lead to a big diplomatic breakthrough, still a big question. We have to hear from the Iranians.
Yeah, Jumana, stay close. When we get that reaction, no doubt you'll have it for us first. Jumana Basecci there out of Dubai. Mark Shaw, the former chief of staff to the former vice president, Mike Pence, joins us now for more. Mark, welcome to the program. 20 minutes ago, we were having a different conversation about ultimatums, and now it's something else. How would you characterize that statement from the president?
Well, look, Jonathan, the president likes to hold all the cards, and he certainly likes to negotiate publicly, as you saw through the weekend. But, you know, I kind of feel in some ways, it's not a perfect analogy, but somewhat similar to the aftermath of Liberation Day. I think we know the president watches markets closely, but not just equity markets, also bond markets. And you've seen treasuries continuing to go higher. And as we head to the midterms, the number one issue for American voters remains affordability. And so certainly if energy prices stay escalated, that has an impact. But if you also are seeing treasuries continue to rise, then I think that has an even greater impact on mortgages and a lot of other things. And so I think that the president is clearly de-escalating here. I mean, to y'all's point about it'll be interesting to see how Iran responds, but if we've essentially basically debilitated much of their offensive capability, I'm not so sure that that is as critical. I mean, I think there's a question about the authenticity about the negotiations, but at the same time, I'm not sure it makes as much difference how they respond if the president is taking his foot off the gas.
Mark, that's what I was going to ask you about, the authenticity and how this is so different from Liberation Day, because the president was almost negotiating in the open with himself when it comes to Liberation Day. He was able to control that lever in terms of how high tariffs would go. With this, you have Israel involved, which as of this morning, we're continuing to target Iranian facilities, and the Iranian regime. Is this potentially just an empty statement?
I don't know, Emery. I think it's hard for Israel to get out in front of the United States on this. I think there's no doubt that Netanyahu has looked at this opportunity ever since October 7th to defend Israel and to take offensive measures. But at the same time, from an international perspective and feedback internationally, I think he really can't get too far out in front of the president of the United States on this. And so I think that the president does hold a lot of the cards here. And, you know, we'll see if there actually does generate some sort of movement in the Straits of Hormuz, or if that, I think, is the crux of the issue to watch over the next 5 days.
Mark, what's driving him? Financial markets or the midterms?
I think that he's probably less concerned about the midterms. I think normally, I think you look at this and say, hey, look, do you really want to go through impeachment again? But I don't think that really concerns him as much. I think he views it as I've overcome that. And I don't think he's ever really worried about others on the ballot as much as himself. And so I think this is more about market reaction. I think he's concerned about the economy. He's concerned about affordability. And look, I think that in some ways, I think the president's success in lowering energy prices in the first year of his administration, in some ways, I think masked much of the cost of his trade agenda. And I think that now that energy prices have spiked, I think some of that will come out, is a more detrimental to the president. So I think that's what's really his focus here, is addressing the affordability issue.
Mark, it's good to see you. Thanks for jumping on and reacting to that breaking news. Mark Shaw, they're the former chief of staff to the former VP, Mike Pence. The president looking for some form of de-escalation. Signal matters. A concern may be about what's happening in financial markets, but I think we have to draw a comparison and contrast between Liberation Day. It's not Liberation Day. There was no retaliation. There was no war on Liberation Day. It was the president. He could dial the lever up. He could pull the lever back. It was in control almost entirely of the outcome in financial markets. This is different. Iran has already come out and said over the past week or so that they want to make it so painful this never happens ever again. And Iran's response in that way is absolutely critical this morning, and that's the headline we're waiting for now.
And also now Iran for sure knows what the President of the United States pressure points are. Higher yields, Jonathan, and much higher energy prices, especially during an election year.
Well, this morning, following those headlines, we've got lower yields. We're down by 4 basis points on a 2-year, around 385. Equity futures much higher, up by 2% on the S&P 500. Up next, Alan Wald of the Atlantic Council on the prospects for talks in the Middle East.
Welcome to Bloomberg This Weekend. I'm David Burke.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Sherianne in Seoul, and this is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
This is the kind of financial market we're all in at the moment. That you can have a market completely turned around and whipsawed by one social media post from the President of the United States. And here is that post from 30 minutes ago. There was a big ultimatum hanging over this market. If Iran didn't reopen the Strait of Hormuz, the US would bomb Iran power plants, decimate them. We've seen these headlines all over the weekend. And we had just 12 hours left before that headline, that ultimatum expired. And then this drops. We're going to postpone the strikes against Iran. Postpone them for 5 days because the talks have been so constructive and so good with our Iranian counterparts.
News to me that there were even talks happening the past 2 days. So a lot of questions immediately. Who exactly is the president talking to, or who are his envoys like Steve Witkoff or his son-in-law Jared Kushner actually talking to? Which is why you were right to point out immediately, Jonathan, we need to understand and wait for a statement from the Iranian side to understand almost the authenticity of these talks. If true, though, the president is saying that there will be 5 days, or maybe he is just buying more time for himself and the DOD. He's saying there will be 5 days of postponement of military strikes against Iranian power plants and energy infrastructure. It also is interesting that he only mentioned those two. Energy infrastructure and power plants are other targets potentially still on the list.
I got this message from a Bloomberg subscriber just moments ago in real time. Everyone's following this. One, it's news that there are talks. One. And two, it's news there are even people to talk to. That seems to be the takeaway from some market participants this morning.
I've gotten a tremendous amount of message. People saying he's tacoing, others saying we can no longer say taco. Stop using that term. This is diplomacy in action. Another person asking me who is the president talking to if we decimated the top brass of the Iranian regime, and we have not seen, physically seen, we've only seen statements from the new supreme leader. There are individuals potentially. Steve Witkoff's counterpart really was the Iranian foreign minister. He's been very prolific on Twitter, as has the Speaker of Parliament, as has the president. These are politicians. Potentially these are people, if the president is saying there actually were talks, and we know authentically we find out there were, these are the individuals I imagine the U.S. is negotiating with.
So let's work through the price section off the back of the statement from the President of the United States. Futures higher. They were down by 1%, now higher by more than 2%. On the Russell, small caps outperforming, up by 4%. Airlines flying at the pre-market, banks are too. The energy names that had rallied over the previous few weeks giving up some of those gains. In the bond market, 2s, 10s, 30s shaping up as follows. Yields were higher, particularly at the front end of the yield curve. Briefly this morning, through 4% for the first time since June, now back down to 3.85. And in the commodity market, the main event, of course, WTI was trading in triple digits overnight. It's now at 90, and we're down by 8%. Struggling to keep up with all of this. Let's get you some morning movers, some single names. Danny has more. Hey, Danny.
Hey, John. The whipsaw on these names has been remarkable. All of the travel stocks rallying and rallying pretty significantly. To be fair, they're not making up for the losses that we've seen. Carnival, for example, is down nearly more than 17% since the war broke out. United is down more than 12% since the war broke out. But all of these names rallying at least 5% off the back of that Truth social media post from the president. The flip side of this, you mentioned this as well, John, it's the energy stocks that are also up double digits since the war broke out, but they move lower alongside the price of oil. Cheniere Energy down almost 4%, Oxy down 2.8%, Devon Energy down 2.3%. Now, not all the moves are logical, but they are happening fast and furious. I want to show you what memory chip stocks are doing, because they have also erased their losses and are now rallying. These stocks have been selling off at the Kospi. The Kospi today closed down more than 6% as some positioning unwind happened because of the fears over the war in Iran. Again, these aren't necessarily directly exposed to the war, but memory chip stocks were down hard. They too turn around, up as much as 2.8% in the case of SanDisk. John?
Danny, take a breath, get some rest. We'll see you in about 60 minutes' time. Who knows where we'll be an hour from now. On our radar this morning, President Trump posting a major update to the war in Iran, instructing the Pentagon to postpone any and all strikes on Iranian energy sites following 2 days of productive conversations with figures in the country. Who in the country? We still don't know. Elsewhere, crude rolling over after President Trump's post. Brent and WTI falling by double digits before pairing some of those losses. And finally, the IEA reporting more than 40 energy assets across the Middle East have sustained severe damage, with refineries and pipelines being choked off. Officials are expecting long-term hits to global supply chains.
So this is where the problem is. Even though you see the energy markets, financially, the paper markets absolutely whipsawing, in the physical market, it is no longer just about the Iranians controlling the Strait of Hormuz and essentially it is closed for most vessels. It's the fact that now actual energy facilities have been disrupted to a point where it is going to take months. And for some of these facilities, like in Qatar, it is going to take years to get them back up to where they were. And that is why you have the IEA coming out with a little bit more of a concerning tone about where the energy space is going, because it's not just what's happening present day. It's 5, 6, 7 months, even 12 months out in terms of potentially the hit to supply chains when it comes to certain commodities.
Can we just sit on this social media post from the president? It's always difficult to get into someone's mind. I don't know what the motivations are. I don't know who they've been speaking to. We're going to have to wait for the Iranian readout of whatever's happened here. But I can tell you that based on the communication I'm having with Bloomberg Terminal subscribers this morning, a number of them who have written to me already, there are severe doubts and a lack of trust with the administration right now as to whether these talks have happened, are happening, or even will happen over the next 5 days.
That's exactly what I'm getting as well. A number of people saying he is tacoing, but is that even real? Also, he has said there's no one to talk to, so who are these talks with? I will tell you, Jonathan, we do not have a statement yet. Iranian officials haven't yet commented. They haven't confirmed that there's been discussions, but there is a headline right now running on Iranian state TV that says, quote, U.S. President retreats after Iran's decisive threats. They're saying they're retreating after Iran's threats. That signals to me potentially there are going to be questions about the authenticity of these talks.
This is the latest from the president posting on Truth Social. The U.S. and Iran have had positive talks, also instructing the military to hold off fresh attacks on key infrastructure. Ellen Wald of the Atlantic Council joins us now for more. Ellen, you've read the post. We've all read the post. You've seen the market moves. What's your reaction to them?
It's incredible how much the market will move based on a post by the president, which has no backing. We've seen no proof. We have limited information from the other side, but it's incredible how much the market is moving, and the market hasn't even opened yet. So I think that we're really seeing in real time just how much this war is impacting not just stock markets, bond markets, and energy markets as well. And I think Anne-Marie's point about how, and we're in a phase now of this conflict where we're seeing long-term damage happen to energy infrastructure across the region, and that's going to be long-term. And I don't think that we're seeing that long-term damage reflected very much in, in the price of Brent. It's really moving based on, a couple words and a tweet, and that's not really reflecting the state of energy.
And signal and substance. The substance, people have questions about the substance. What does it signal?